This solution is the takeover of Credit Suisse by UBS.
The bankruptcy of Credit Suisse would have had a collateral damage, a huge collateral damage on the Swiss financial market.
This really is a crisis of confidence. And so that's also why the solution is not the classical too big to fail solution.
Here we had a problem of liquidity, so it is not typical at all.
The combination of the two banks further strengthens UBS's position as a leading global wealth manager.
This is a special edition of Bloomberg Surveillance with Jonathan Ferro and Lisa Abramowicz.
Live from New York, coming up on the programme, avoiding another weekend cliff edge, UBS agreeing to buy Credit Suisse. The Swiss government brokering a deal for more than 3 billion Swiss as officials worldwide race to restore confidence in the financial system. Lisa Abramowicz, have we created a monster or found a solution?
It's a great question. Let's define the monster, right? On one hand, you've got the monsters of moral hazard, which it seems like this has been created. On the other hand, you have this question around, does it create more uncertainty at a time where people are wondering, is this it? The unknown right now in terms of the monster is whether we see ongoing accelerating panic in markets on the heels of what we saw over the weekend.
The fear quite clearly, Lisa, is who's next. Last weekend we're dealing with SVB and Signature Bank. This week we're dealing with Credit Suisse. Who's next weekend? 2 weekends running. We've been sitting here waiting for a last-minute solution going into the open of Asian trading. That's a problem.
You never want to have all of the officials around the world coming out and saying everything is fine. Do not worry. Everything is solid and sound, and the financial system is steady as they pour billions of dollars into the financial system and say it's not a bailout. You do not want to be in that situation.
Big programme coming up for you. Team coverage begins right now with Bloomberg's Manus Cranny in Zurich. Mike McKee here in New York City. Manus Cranny, we have a deal.
Johnny, we do have a deal, and there are a couple of critically important things to take away in the first take. One, we have a bail-in of bondholders. This is what the market will focus on tomorrow morning. When I got on the plane in Dubai this morning, this was a $1 billion deal. This afternoon in Prada Platz, it was a $2 billion deal. It's now a $3 billion deal, and it has a lifeline, $100 billion from the regulators, the SNB. They're standing behind this. And Colin Kelleher made it very, very clear. This is the man who steered Morgan Stanley through a bailout in the GFC. He made it very clear. We're not in the risk business. We're a capital-light model. And the investment bank at Credit Suisse will be reduced to 25%, approximately. That is the size. The backstop is in. The liquidity is there. Systemic risk for now. We'll see how we go over the next 12 hours. For now, this is a salvo at saving systemic risk.
Manus, does this solve the problem? And that's really the key question as we're talking about what people will debate, a bail-in versus bailout.
It's critically important that we understand what AT1s are, which are the additional Tier 1 capital. They were put in place as the fundamental backstop to another situation like this. My first take on this is that the bail-in is a message from the Swiss to say, look, somebody's got to take pain here. The equity holders will get a little bit of something, in other words, 0.76 Swiss francs. But the bondholders who get handsome yield for AT1, those days are gone. My question will be how the credit markets react tomorrow morning across Europe, and most especially within the banking sector. The other dynamics that you've got to keep in mind is this. There is also a backstop if things go wrong. And Kelleher made it very, very clear that they're not in the business of trying to make losses. They're going to look at the whole book, the whole credit book, the whole derivatives book. They're on the hook for $5 billion, and then the SNB comes back in, and they're on the hook for 9 after UBS. So there are a myriad of things to keep in mind here. I just want to put one other thing to the two of you, which is this. At the moment, it looks as if no dividends are to come from Credit Suisse. I've got somebody screaming blah, blah, blah. He'll get a lot more blah, blah, blah before I'm finished. The bottom line is UBS is a dividend bank of choice, but what I didn't hear in that news conference was that there's any pause, cessation, or temporary pause on the dividend from UBS. Kelleher is chairman. Ralph Hammers is the CEO. The king is dead. Long live the king. And that king is UBS.
Manus, I thought that people in Zurich were interested in this. Blah, blah, blah.
Blah, blah, blah.
Manus Cranny in Zurich. Manus, we're going to leave it there. Thank you. My Bloomberg terminal on a Sunday evening, lighting up. with the same question that Francine Lacqua asked brilliantly in that news conference. Why is AT1 at zero, but equity somehow retains value? Why?
There will be a lot of questions, a lot of people looking to those particular capital instruments as designed specifically for this. So if they weren't impacted, that would be a serious issue. That said, why not equity? Who are they catering to? Which of the equity investors that were the loudest voice in this?
Politics. You're hearing politics, you're smelling politics.
It's
That's what people are saying to me right now.
I mean, right now, how could it not be politics when there's a question of a bailout at a time when all of these regulators said this will never happen again after 2008?
Mike McKee in the studio with us this afternoon, I'm happy to say. Mike McKee already hearing from authorities on this side of the Atlantic.
Well, the Fed and Treasury have, and through the FDIC, have responsibility for the Credit Suisse operating divisions here in the United States. And we don't know exactly whether they have to have a veto approval of it, but they have put out a statement welcoming it. Here's the statement from Jay Powell and from the Treasury Department. We welcome the announcements by the Swiss authorities today to support financial stability. The capital and liquidity positions of the U.S. banking system are strong, and the U.S. financial system is resilient. We've been in close contact with our international counterparts to support their implementation. Now, reporting has been, and we have been guided to the idea that this is all the Treasury or Fed are going to say today. A lot of people were waiting for them to come out with something more to support the U.S. banks that are in trouble. And guys, we saw everybody up on that dais blame the U.S. bank system for what happened to Credit Suisse.
And Twitter.
A lot of people wondering, what is going to be the status of First Republic and PacWest and Western Alliance when futures start trading. And the AT1 question is going to arise here in the United States as well.
Yep.
So there's going to be an awful lot for investors to sort out over the next few hours. And from what I'm hearing, we're not going to hear any more from the U.S. authorities tonight.
I don't think you want to be sitting around a table blaming Twitter after an issue like this. Lisa, what did you make of that?
I think when everything else fails, you blame Twitter, right?
That's ridiculous.
This is the sentiment-driven kind of fear, right? And that's the issue. How do you sort of blame social media and the modern era for the rapidity for which people can spread concern and withdraw cash?
Mike McKee, stay close. With us now, I'm pleased to say, waiting patiently, Mohamed El-Erian, Bloomberg opinion columnist, president of Queen's College, Cambridge. Mohamed, I'm not sure whether to say good morning, good afternoon, good night, because it's like Friday never ended. What did you make of this deal?
It shows you the complexity of what they had to do. Look, this was not the best solution, but it dominated the other two, which was either nationalization or trying to wind down the bank. But it's full of contradictions. You spoke about AT1 versus equity. It's a private sector solution, but has government intervention. It's not clean, but of the available options, this was the best one that they could have had.
Mohamed, was this a bailout?
Yeah, it was a bailout. There's $9 billion of contingency credit guarantees there. There's $100 billion of liquidity support. Yeah, it was a bailout. But, bailouts, the phrase bailout has become such an awful phrase that everybody's avoiding it. They're going out of their way to say it's not a bailout. But then they can't explain why money is being put to work. Yeah, it is a bailout, and it's a bailout. And you heard the minister say, it's a bailout because they're dealing with a systemically important bank at a time of market turmoil. Now, of course, you're going to always be dealing with a systemically important bank at a time of market turmoil. That's by definition what happens when you have a systemically important bank in trouble. But they just don't want to use that phrase, Lisa.
Mohamed, this idea that we're in a moment of turmoil and that all of the Swiss authorities and all of the banking officials were blaming regional banks in the U.S., what do you make of that in terms of the risks that we don't know, that we don't see, that are continuing to percolate over on the other side of the Atlantic?
So it's important to recognize what is in play here. You have three levels of influences. One is institutions with long-standing weaknesses, like Credit Suisse, or in the case of Silicon Valley Bank, with some imbalance, some mismatch. Add on top of that supervisory lapses, certainly for SVB. And then third, which is something that you and I agree on, I think, is that we have had one of the worst handled interest rate hiking cycles where we started too slowly. We didn't even start because we thought inflation was transitory, according to the Fed. And then even when it was no longer transitory, the Fed didn't really move. And then we front-loaded a tremendous amount of tightening. And that is impacting a lot of entities, not just banks, but beyond banks. So this is not over yet, unfortunately. And there's also the question of what's going to happen to First Republic, as Mike McKee rightly said.
Well, there's a word, Mohamed, that I think makes a lot of people nervous, and you hear it all the time: idiosyncratic. Last weekend, SVB, the Bank for Startups and Venture Capital, idiosyncratic. Signature Bank, crypto, idiosyncratic. Credit Suisse, they've had problems for years. Idiosyncratic. Then we talked about First Republic last week, and people were talking on this program as if they were just chasing billionaires in Wyoming. Idiosyncratic. At some point, Mohamed, don't we just have a big problem?
Well, we're starting to. John, I can tell you, I spent a lot of time this weekend talking to people who are asking me a simple question: are my deposits safe? And I would say, yes, they are safe. And then they ask me the following question: well, what do I lose if I move them to the largest banks? What do I lose? And it's hard to argue that you're going to lose something. So people are doing something that probably is not rational, but totally understandable, which is they're moving deposits. And where they're moving deposits out of, the smaller and the medium-sized banks into the larger banks. And that dynamic isn't going to stop overnight. Neither are the losses that are being incurred. You've wiped out 17 billion of AT1s. There's going to be a lot of repricing in the credit segment. So this is going to be pretty bumpy going forward.
You've touched on the issue that they have to resolve in the US. Never mind the Swiss and the Europeans. In the United States right here, right now, it seems like a two-tier banking system. And what's curious about this situation, Mohamed, and you know this, we already knew that because it's implied by what you see in the rules. Quite clearly, if you are systemically important, you are exceptional, and all your depositors will be made whole. And if you are not, they won't be. And what's interesting about the last week, Mohamed, is that no matter the size, last weekend, we were told that those banks were systemically important and all depositors would be made whole. And you would think that that would imply that all depositors everywhere would be made whole. And then Secretary Yellen was asked about it this week, and she can't say that they will be. Now, I just wonder, Mohamed, what on earth they're going to do to resolve that situation, never mind over the next few months, but quite literally this week.
John, they've got to turn de facto into de jure. De facto, all deposits are guaranteed in the United States banks. Okay, there's no way you can guarantee the deposits for SVB and not guarantee them for the next bank. Why? Because you're going to be accused of protecting the rich, protecting tech. It just doesn't make sense. They've also acknowledged by triggering the systemic risk clause, they also acknowledge that medium-sized banks are systemically important. So I think we've gone down that road, and I agree with you. The quicker we acknowledge this reality, the better. But we've also got to deal with supervisory lapses. SVP exploded in size under the nose of the Fed. And that's what's troubling people, is that there were massive supervisory lapses that there was an attempt to brush them under the carpet. That doesn't build confidence in the U.S. banking system and doesn't build confidence in the Federal Reserve.
Have you heard about other banks then, Mohamed? I mean, basically, this really indicts one of the main regulatory tools that some people argue has been softened under Randy Quarles. Are you concerned about other institutions that are known to have issues, or do you think that we really have seen the worst offenders?
I don't know, because even banks that have no issues, that just happen to be in the wrong neighborhood, may suffer deposit withdrawals. There's a reason why the discount window use shot up to even more than 2008. These are all medium banks, size banks, looking for liquidity to meet deposits that are simply being reallocated within the system. And again, ask yourself that question. If one of your relatives were to call and say, what do I lose by moving my bank from a mid-sized bank to one of the big ones? What are you going to say? What do you lose? You don't lose anything. It's very easy to do. And that's what people are doing because they are naturally risk averse when it comes to their deposits.
It's a fair question, and it's a fair response, and it's raising the specter of the role that a lot of these medium-sized banks play in the economy in the United States. Torsten Slok of Apollo has been really excellent on this, highlighting the credit impulse that is generated by loans to commercial real estate, loans to individuals by some of these smaller and regional banks. Why is it that those loans are not being extended by the big banks that are getting these deposits that don't even want them? In other words, where is this credit impulse going to come from if it's not these regional banks?
And that's the contagion that we're not talking enough about. We're talking a lot about the risk of financial contagion, but there's economic contagion. And we're going to see two influences that speak to less credit being available to businesses and to individuals. One is exactly what you said, which is that banks that are lending, that these relationships are going to be harder to sustain as the deposits move out of those banks. You're also going to see banks becoming more risk averse in general, expecting greater regulation, tighter regulation, and we will get tighter regulation. So the economic contagion is something that we need to start talking about and analyzing, because it is yet another headwind to an economy that so far has proven to be really robust.
If you are just tuning in live on TV and radio and wondering what on earth we're doing here, we were wondering the same thing.
So are we.
For a second.
Let's be honest.
If you are just tuning in, welcome to the programme. We have a deal for UBS to buy Credit Suisse for $3.25 billion. Does it end the crisis, Lisa? That is the big question right now.
We'll see as we have futures open up. We'll see when we get a sense of the credit default swaps of some of the other European institutions. It doesn't stop the questions in terms of what the broader risks are that regulators around the world are scrambling to fill the void in.
And you don't need the tail risk to materialise. You touched on the work of Torsten Slok of Apollo. Torsten wrote this over the weekend. Here's the quote for you. Quantifying the impact of tighter financial conditions plus tighter lending standards, we estimate the events this past week correspond to a 1.5 percentage point increase in the Fed funds rate. The risks of a sharper slowdown in the economy have increased. Now, Mohamed, if you'll allow us, we should shift towards Chairman Powell in a couple of days. What on earth should this FOMC do?
Yeah, well, when you dig a hole for yourself, okay, and someone else adds to it, then it is really difficult. It's going to be a really tough decision, John. Really, really tough. I think he's got to stick to the framework that the European Central Bank set out very well. And President Lagarde had a masterclass in her press conference on this, which is we are aiming both for price stability and for financial stability. And we have tools to address both of these things. And we must not sacrifice either of them. That's what he's got to get across. And it's not going to be easy.
Well, and that's really that really goes to the question of supervisory. If you can't guarantee that you've got your finger on the pulse there, how do you guarantee that you can do these sort of dual mandates? At what point does him not raising rates by 25 basis points create a much bigger risk, both with respect to inflation as well as perhaps breaking banks that are dealing with interest rate risk that perhaps is not adequately hedged?
That's the balance he's got to strike. I mean, the ECB was clear. They felt that if they had not raised 50 basis points, they would have caused more damage to the financial system than by raising 50 basis points. And that experiment, which of course now is way in the past, even though it's only last Thursday, but that's the nature of the world we're living in, that experiment was successful. Financial markets rallied, and it turns out that that was the right judgment. The Fed is going to have to make its own judgment, and it's not an easy one.
Do you think that the situation in the United States is materially different than the one in Europe? This is the argument people are making, that in Europe, they are much further behind in their fight against inflation. In the U.S., there already has been this dramatic increase in rates that clearly has had lag effects that are taking effect now. Do you buy that argument?
It's had lagged effect on the financial system. It has not had enough of lagged effects on inflation. I remind you, Lisa, that core inflation re-accelerated. We're dealing with a trilemma, not a dilemma. We're dealing with the need to A, lower inflation without B, sacrificing growth too much, without C, sacrificing financial stability. And because the Fed was so late, that trilemma has become a really difficult one. We still have an inflation issue. And the worst thing is to end up in a stagflation world.
Mohamed, I've got about 45 seconds left with you. Let's just wrap it up. What are you looking for? Never mind the rest of this week. I'm talking quite literally about tomorrow morning. What are you looking for?
First and foremost, the UBS-Credit Suisse deal. right? How do the UBS shareholders and the UBS bondholders take it? That is absolutely critical. Hopefully they'll take it well, but we just don't know. That's issue number one. Issue number two is First Republic. Bloomberg is carrying a story that S&P is about to downgrade First Republic's rating deeper into junk from BB plus to B plus. That would not be good news. That would make First Republic's life much harder. So we have to keep an eye on First Republic. And then the spillovers from all those two.
Mohamed, appreciate your time, as always, sir, particularly on a Sunday evening. Thank you for that. Mohamed El-Erian of Bloomberg Opinion, and, of course, so much more. Did you see that note? And we need to talk about this. Mid-sized banks in America basically pleading with American authorities to ensure all deposits.
Right.
For what was it, 2 years?
For 2 years, basically coming out saying, please, FDIC, listen, you got to prevent some of these bank runs. And there is an ongoing concern, this consortium of mid-sized U.S. banks. This raises, again, the question of what kind of outflows they saw of deposits. I mean, we heard that from Credit Suisse, there was about 10 billion Swiss francs, or more than $10 billion worth of deposits being withdrawn per day by the end of last week. What is that scenario?
It's pretty ugly stuff. Pretty ugly stuff. Lisa and I are going to stick with you through the next couple of hours. Looking forward to doing that with you. Coming up very shortly, in about 15 minutes, we'll catch up with Peter Chip, the head of macro strategy at Academy Securities. Talk to him about the latest deal between Credit Suisse and UBS, and of course get his thoughts on the banking system here in the United States. We have a deal, finally. UBS agreeing to buy Credit Suisse for 3 billion Swiss francs. Live from New York City this evening. Good evening to you. This is a special edition of Bloomberg Surveillance alongside Lisa Abramowicz. I'm Jonathan Ferro. What a week for Credit Suisse. The CEO earlier this week attempting to inspire confidence.
I'm fully convinced of the strategy. We are executing at pace. We have the right team. And, that's why we said in October it needs radical change. The bank needs to be changed. And we said it's a 3 years transformation. And you can't come after two months and say, look, why is not everything done?
The bank's top shareholder, following that conversation, doing very little to allay concerns.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in.
Following that, a public display of support from the regulator and a major central bank lifeline, not enough to prevent Credit Suisse from coming into the weekend fighting for its future. It all ends like this.
This solution is the takeover of Credit Suisse by UBS. The Federal Council welcomes this takeover and is supporting it by guaranteeing the framework conditions necessary for its success.
At the forefront of some of those conversations, joining us now is Bloomberg's Francine Lacqua in Bern, Switzerland. Francine, it was only literally days ago you were sat there with the CEO in London together with the studio. He was fighting for this institution's future. This is how it ends.
Yes, this is how it ends. 5 days on, I have to say things moved pretty fast. Now, we just finished this press conference, really historic press conference with the two chairmen of the two banks. There was the S&B president, and there were, of course, a couple of not only the finance minister, but to the regulator here, FINMA. Now, 3 points that we need to make. First of all, they decided to wipe out AT1 bondholders, but give something back to shareholders. Many questions on that press conference, what that means for the future, what that means for precedent. The other thing that the Swiss finance minister was at pains in saying, this is not a bailout, because a lot of the questions, of course, focus here when we found out details of the deal. Well, look, we were promised no bailouts for the future after the financial crisis. If you look at Credit Suisse, it had a lot of problems. They had a lot of outflows. It had, of course, a lot of concerns going forward, but it was fully capitalized. So if you're a bondholder in Credit Suisse or any other bank, how do you take the news? The other question, and we spoke to the UBS chairman many times, a couple of times, we had a couple of questions with him in the presser, is what happens to the investment bank? What happens to the Swiss bank? And this, he was saying, look, they'll absorb it. Actually, they'll probably wind down the investment bank. We also spoke to FINMA. This is the local regulator, and we asked him what kind of transaction, of what kind of talks he also had with the Fed and the Bank of England. Here he is.
We were speaking very closely with key regulators, those that are most relevant for Credit Suisse Group and for UBS. notably, or most importantly, the ones in the US and the UK. They were deeply involved, and you have seen today their support for this solution as well, their strong support for this solution in the sense of, or with the purpose of financial stability.
So there was a deal, the first deal of two systemically important banks through the financial crisis, and we'll have to wait to see how the markets open tomorrow.
Francine, looking forward to your coverage tomorrow from Zurich, from Bern to Zurich. Francine's going to be busy across Switzerland throughout the rest of this week. You heard what Francine said there, and I think it's important. We heard from the President of the United States several days ago after resolving some of the issues in this country last weekend with Silicon Valley Bank. Keen to point out this is not a bailout. And again, Swiss authorities going out of their way to say, guess what? This is not a bailout. Now, we're saying this is how it ends. I would be asking today as well, is this how this will end?
We will find out when we take a look at the credit default swaps, the bonds and the stocks of banks around the world. In terms of a bailout, you heard Mohamed El-Erian just there. It is a bailout for all intents and purposes, perhaps not what you're talking about with the specific contingent capital instruments, but 9 billion euros, Swiss francs rather, being put toward losses at UBS stemming from Credit Suisse assets. So that gives you a sense of what we're talking about.
You know,
here.
Lisa, we talked last week about officials, authorities learning from a previous crisis, moving quickly, if you will. Is it fair to say the banks have learned from a previous crisis as well? And I'm thinking of JPMorgan. The lessons learned there, basically inheriting some of the regulatory and legal issues from an institution they take over at a time of crisis. Do you think UBS has learned that lesson from that? Is that why that's there?
Are you suggesting that UBS really drew a pretty hard bargain here, saying to all of the authorities in Switzerland, you've got to cover all our legal costs, you've got to cover all potential losses and assets that we don't know, the black box of
I'm sure that's how the
potential
conversation
legal.
started.
I'm sure it did. You know, these are all of the reasons why we cannot do this unless you backstop all of these things. And Swiss authorities said, okay.
Think about how the weekend went. We went from 1 billion to 2 and now something like 3. And then at one point we were talking about state involvement, partial or full ownership. This moved pretty quickly over the weekend.
It also really speaks to, and I hate to use this word, but desperation to get it done before Monday.
I'll use that word without a doubt.
This is
You can smell
absolute
it.
desperation. You could smell it because they basically were just that worried about what would happen to this bank Monday morning when they walked in if this deal wasn't executed.
UBS agreeing to pay 3 billion Swiss francs for its long-time rival Credit Suisse. Joining us now is Juice Beaumont, the head of bank research at ABN AMRO. Juice, wonderful to hear from you, sir. Let's just start here. What do you make of this one?
Well, I tend to agree with the fact that it looks a bit like a bailout indeed. Quite some large guarantees given to absorb the losses. And what it in the end reflects, I think, is the tension there is between a bank that is too big to fail. You want to protect depositors, etc. So in the end, governments might need to step in to help failing banks, especially if they are so large as Credit Suisse. And that is something that is a little bit within the system that we have at the moment. So it looks indeed a bit like a bailout.
Just, we heard authorities there from Switzerland, banking executives, say that a lot of this stemmed from what we saw over in the United States with medium-sized banks. Does that pass the smell test for you?
Well, I think with the medium-sized bank, I think there are two things here. You have the U.S. cases, the regional mid-sized banks. You have Credit Suisse. Maybe if you continue with Credit Suisse, I think it was already a very beleaguered bank in trouble. Something needed to happen. Moving to the US, these regional banks, I think they were so vulnerable because they had a lot of uninsured deposits, of course, making them very vulnerable for bank runs. And then also the way, especially with Silicon Valley Bank, how they had mismanaged basically their assets and liabilities, made them also extremely vulnerable. And you can even say it goes a bit back to 2018 when the rules and the oversight of these mid-sized banks were basically eased, which kept them a bit off the hook of the regulators.
You could connect the two, Juice, by just saying that right now, given the potential risks that have been highlighted in a couple of potentially idiosyncratic instances, that investors, credit people who have their money in a bank want it to be a safe, big bank with no potential risks. Are there other big banks in Europe, in the U.S., that perhaps might be vulnerable to significant amounts of depositors withdrawing their cash?
At first sight, I would say no, or at least there's limited risk. I think if you speak for Europe, I think the deposit guarantee scheme is more effective in a way. If you look at European banks, the coverage of deposits is way higher than what it is for, say, the smaller regional banks in the US. If you look at the larger US banks, this is also the case. So the risk for depositors to really run away from a bank is less in that respect. Also something in Europe, if you look at the investments that banks have, so the risks they have to they run if they need to sell assets is also less than say the regional banks in the US. So my first feeling when looking at all the bit more top down numbers still makes me think that these cases are special cases, but of course it runs the risk if a lot of mid-sized banks in the US run into trouble, then of course it's the ball that starts rolling, and then it can become a systemic issue.
Juice, whenever things get messy, we start throwing around acronyms, and I think it's difficult for people to follow. And a lot of people outside of banking right now might be tuning in wondering what on earth is going on with this name. And then they hear things like AT1. Now, we know that market is huge in Europe. It's about $275 billion. What on earth is going to happen with that market after what happened with this bank today?
I think a lot of investors will reassess how they need to assess the risks to these instruments. Of course, these are instruments very equity-like. You run a large risk, you get a higher return. I do think that maybe also investors or financial markets more generally have been living a little bit in like a Goldilocks scenario, pricing in that the sharp increases in rates should not really leave their mark on the financial sector. And in that respect, this is also a wake-up call, and therefore should make investors assess the risks they run to the banking they have against the banking sector more carefully.
It's going to be an interesting week ahead in that market. Just by on there of ABN AMRO. Lisa, what do you make of that decision around Credit Suisse?
I think that what it's going to do is make it a lot more expensive for banks to raise capital, because this has basically been one regulatory option, a sort of safety net to protect against losses, to prevent another bailout. So, yes, of course, it was triggered in this particular instance. But what does that do for all of the other banks that are forced to have these kinds of instruments? How much are they going to have to pay up for people to take that risk?
It's going to be an interesting couple of days. Never mind that. Was it Dan Iverson of PIMCO? That quote that he had earlier this week with our team here at Bloomberg sticks with me. This is going to be a multi-month process. A multi-month process. Not a band-aid on a weekend, on a Sunday evening, going into the Asia Open, going into Monday. A multi-month process.
Because it's a liquidity issue. It's the fact that perhaps depositors are rethinking where they put their money, and there is a question about what other banks are stressed in response to that, and what happens to their assets, since these were a lot of the banks that were providing some of the credit to a lot of the areas that got the most inflated during the decade of zero rates.
We're going to stay with you, working through some of these issues. Up next on this programme, coming up next, Peter Cheer, the head of macro strategy at Academy Securities, live from New York City this evening. This is Bloomberg. Live from New York City this evening. Good evening. Alongside Lisa Abramowicz, I'm Jonathan Ferro. This is a special edition of Bloomberg Surveillance. We have a deal between UBS and Credit Suisse. The number 3 billion Swiss francs, $3.25 billion. There's a lot of things we need to get through in this deal, though, Bramo. Here's one, the 100 billion franc liquidity assistance that's going to be offered to UBS from the SNB. Here's another, a $9 billion franc guarantee for potential losses from assets UBS is taking over. There's a new one.
Well, that's the question that people are looking at for the bailout kind of definition, because essentially that is bailing out losses. I guess that the way that they try to paper over that is the $16 billion of equity-like bonds that are going to get wiped out. And that perhaps is the pain that the regulators are trying to inflict on risk holders to say, it's not just us.
Peter Cheer's with us. Looking forward to this conversation. Head of Macro Strategy at Academy Securities. Peter, we're leading with this story. $17 billion of risky bonds, worthless. AT1s, gone, written down. The equity retained some value. Can you make sense of that?
Yeah, supposedly, I guess they triggered it under some sort of viability clause, but this is going to raise a lot of questions, right? Why should I be in AT1s if it feels I'm treated unfairly or picked on? And what I'm looking for is, A, who's holding those AT1s? So does this spread the risk then to whether it's insurance companies, pension funds, some other part of the financial world that we haven't really seen dragged into this mess at all? And finally, the size of the loss that's occurring seems much bigger than anyone expected, right? The equity is getting devalued much more than was trading last week. You've got this weird $9 billion that's supposedly going to be contributed. What do the books look like? Does this give people confidence, or does this make people question the banks?
Let's put this into perspective. The $16 billion Swiss franc write-down of these particular instruments would be the biggest of the $275 billion market for this debt. How much does this essentially raise financing costs for a lot of banks that are forced to raise these instruments to be in Europe?
I think no one's going to be buying these for a period of time, right? You got to look at this and wonder, how did this happen? What happened? And again, it didn't follow any leverage rules or any capital rules per se. It came under, I believe, this viability trigger. So it adds a new element of risk. So I think this market's going to be for sale from the secondary standpoint, and I don't think people are going to be able to raise capital in this.
What did you make of the Swiss authorities coming out and blaming the U.S. mid-sized bank and some of the turmoil there for what happened with Credit Suisse?
I think they're kind of two separate issues. They're somewhat, at some level, the one problem is it seems that a lot of banks have assets that are held at par or whatever the purchase price is, and the current valuation, due largely to interest rates, not credit, is lower. So that's everywhere. I think I was actually on with you guys on Wednesday morning when the Saudi person spoke and kind of was very dismissive almost of their investment, and that seemed to trigger a lot. So I think there's a lot of moving parts. I think what it does highlight is the system is very fragile in the banking system, right? Companies are levered. I think they're well managed, but when things get exposed or moved, it moves quickly. And I want to see the regulators respond faster than they have. I would really like to see the Fed or FDIC come in and do something for all bank deposits, because I think that's a risk.
Do you think that needs to be done imminently?
I would have expected and liked to see it done today, right? I think you can almost implicitly say, well, if they bailed out the depositors of SVB and Signature Bank, they'll bail out other depositors. But why not get ahead of that and stop this? I think El-Erian was on, and I don't always agree with him, but I think he was right on this, is if you get asked the question, well, is my money safe? I would say yes. Is there any cost to moving it? Not really. So I think that's what has to be addressed, is this, so it stops banks from being forced to sell assets, which then trigger these losses.
What should be the limit? Senator Warren was speaking to Face the Nation, a show here in the United States, over the weekend, today, I believe. And she said, what is it, $1 billion? It's just a number, $1 million, $2 million, $3 million. What is the number?
That is a great question. I'm also not sure why we didn't spend some time figuring out, in the case of SVB, what the recovery value might have been. Maybe you have to cover up to a certain amount, and then there's a recovery. It's been very quickly. I think we should have put some stopgap in place. But ultimately, all of this comes down to getting capital. And I think that's why you saw the AT1s get hit here. That's why the Swiss National Bank is putting up that potential extra $9 billion, however it's defined. It's going to be about capital, and that's what we need to see in the U.S. banking system, is deposit protected to give us that opportunity to raise capital.
You said you don't always agree with Mohamed El-Erian, and I'm curious what you think about his assertion that this Federal Reserve has to come out and raise rates to follow what the ECB did by 25 basis points to say, look, we're going to deal with the financial system itself, but we are dealing with inflation, and we're not going to let that go.
So that part I completely disagree with him. I think we were seeing deflationary pressure coming into January. Then we slowed down. We saw little bits of inflation here and there. The wage numbers were under control. I think now you have to say, we don't know what's going on with the banking system. Nothing about a slowdown or tightening in financial credits is going to be good. So I think you pause here and say, we want to see where this all comes out. If we still have inflation in a month or two, we will worry about it. The price of oil has been plummeting. I don't think you do that. If anything, I think you maybe bring up, I don't think you do this time, but you talk about maybe we suspend quantitative tightening. Maybe we stop reducing our balance sheet while this is going on. So if anything,
I think they go anyway.
I was about to say the exact same thing.
Well, it's been growing, but it's been growing at the short term. Yes.
I can't try to explain this one.
You're right. So yes, the balance sheet has been growing. So maybe this would make it even more explicit that, hey, we're going to suspend this for now. I don't think they enter into large-scale asset purchases, but I think we're more likely to head that direction. And inflation, let's see how this all plays out. We just had a very big event here. People are worried about the banking system. Inflation should not be the priority, especially when you've seen things like oil come down, wages come down. Let's be honest.
It's certainly not the cleanest way of doing it, but doesn't financial instability take care of the inflation issue for them?
Sadly, I think it does. It just causes problems. It might cause bouts of inflation, but I think financial conditions are now going to tighten everywhere you look at it, right? Banks have to protect their balance sheet. They are less likely to lend. That will slow down this economy and, in theory, inflation.
So let's say there's somebody out here who's listening to this and saying, how should I position in Monday morning? And they're thinking, okay, well, if the Fed stops quantitative tightening and doesn't hike rates, risk on. How do you basically make the argument that Morgan Stanley's been trying to make for quite a bit, which is basically the tightening that will ensue from a lot of these regional banks pulling back on credit will be perhaps not the best for risk assets for quite a time?
So I would probably lean towards I've been trying to buy and sell the financials, and assuming we get any dip, I'd probably buy some of the regional banks. Again, I think this will ultimately get taken care of. It's not happening all at once, and you probably have to go back to shorting some of the big tech, some of the names that really took the boost last week, right? Because last week we almost had this Pavlovian reaction: lower rates, higher tech, higher ARC. And I think the reality is this time is going to be different. Starting conditions are much different. And this is happening because of a recession risk. Spending is going to slow. People aren't going to spend money on that. So I think we had this knee-jerk reaction that I want to fade. So I've kind of looked for the opposite of last week's trade.
Pete, don't you get the feeling, though, we've got no idea what's going on right now? On Friday at the close, the market took care of business with Credit Suisse and priced it at 186. What did this deal close for? 76?
Yeah, something like that.
OK, so what, 3 billion Swiss? They raised 4 a couple of months ago. They raised 4 billion, and now it's worth 3. And I was told repeatedly that the Swiss unit was worth, 10 billion?
Correct.
And they're getting that for 3, and they need to throw government guarantees in there as well. Now, that's just Credit Suisse.
And take out the AT1s, don't forget that.
Does that not make you just pause and say, there might be some stuff that I don't know here?
I think the fear everyone is going to have is if we get a look behind the balance sheets and really what's in there, are the losses more concerning? And in all these things, right, we all know what it costs to sell a treasury or sell a mortgage bond, right? There's a bid out there. But if 10 banks are all selling that same bond, the bid will be lower. If 30 banks are out getting 4. So that is why I think we've got to stop this deposit flight, because it creates effectively forced sellers, and price doesn't become the object then. So yes, I think that is the risk. And that's why I'm not in love with what happened in Switzerland today. I don't think it solves the problem for Europe. I think their problems are different than ours. Here, I think a deposit guarantee would really solve this issue for us, or at least put it on hold. But that's going to be the scrutiny that the bank balance sheets are getting is going to be intense, and it's intensifying. And more people want to know, what do you have, not just in terms of the details of your maturity, the types of assets, but even where are your deposits? Where's your cash sitting? Yeah. That's a new thing.
Hey, Pete, this was great. Thanks for dropping by. On a Sunday of all days, here we are. Peter Cheer of Academy Securities. First Republic Bank will need to talk about 11 banks getting together in America, depositing 30 billion US into that institution, and a stock closed Friday down almost 33%. The conversation continues from New York. This is Bloomberg.
If you think about where we were a year ago, the Fed was just starting its rate hiking cycle. So over the next couple quarters, you're going to get those long and variable cumulative and lagged impacts hitting the market further. So I think this is the tip of the iceberg. I think there's a lot more consolidation, a lot more pain yet to come. So you put your money into the highest quality assets you can find, whether it's government bonds or high quality corporates and securitized credit.
Bob Michele of JPMorgan Asset Management joining us around this table in just seconds from now. Lisa, that takeaway from the conversation we had earlier this week, tip of the iceberg for him.
Which is the reason why he thinks the Fed should pause, given that there is this cumulative lag that is coming to the fore now. He says it's the tip of the iceberg with respect to credit deterioration and impact from the Fed rate hikes, not necessarily the tip of the iceberg from the financial system distress. That, I think, is the question tonight as we take a look at what happened with Credit Suisse.
What would you make of the argument that we've got a solution for Credit Suisse? Maybe. Last weekend, we had a solution for banks in difficulty in America that should allow them to just focus on one thing: monetary policy and inflation. What do you make of that?
Well, first of all, it's not that simple. We all know that. We just don't know yet in terms of how far they've gone to stave off the distress. But we just don't know. I mean, what did, and this is something that some people have just mentioned, which is what did UBS see that required it to have all of these demands for the deal to be done?
Well, they took a look under the lid and didn't like what they see, right?
So
we kind of anticipated that through the weekend.
What did they see?
Yep. That's going to be the conversation into tomorrow morning. We're going to stick with you. Bob Michele of JPMorgan Asset Management. Up next.
This solution is the takeover of Credit Suisse by UBS.
Yeah, it was a bailout. There's 9 billion of contingency credit guarantees there. There's 100 billion of liquidity support.
I can reassure the members of the committee that our banking system is sound.
I was around in 2008. I think that the banking sector is currently in a much, much stronger position than where it was back in 2008.
Americans can rest assured that our banking system is safe. Your deposits are safe.
This is a special edition of Bloomberg Surveillance with Jonathan Ferro and Lisa Abramowicz.
Live from New York City, coming up, avoiding a weekend cliff edge. UBS agreeing to buy Credit Suisse. The Swiss government brokering a deal for more than $3 billion as officials worldwide race to restore confidence. From New York City, for our audience worldwide, good evening. Alongside Lisa Abramowicz, I'm Jonathan Ferro. A special edition of Bloomberg Surveillance continues. Lisa, we have a deal. We've been asking this question for the last hour. Have we found a real solution?
I think the answer is probably there are more questions than answers right now in terms of the fallout, in terms of just what exactly was agreed upon and why. And yes, we have some of the details, but we don't understand what UBS's rationale was for some pretty steep pushback that we saw evolve over the weekend.
Let's get straight to the team coverage. Joining us now is Bloomberg's Francine Lacqua in Zurich, Kelly Lyons in Washington, Mike McKee here in New York. And Mike McKee, just moments ago, a little bit of breaking news.
Yes, another statement out of the Federal Reserve, and it's also coming from the other central banks, major central banks around the world, addressing the possibility of a liquidity problem in one small area of the markets, and that's if you're making cross-border payments. The Federal Reserve, the Bank of Canada, Bank of England, Bank of Japan, European Central Bank, and Swiss National Bank are expanding the frequency of their swap line transfers to daily from weekly. So there will be cross-border currency available if you need it through your central bank. They already have these swap lines in place. I would imagine that most of the action would come with the Federal Reserve, but certainly with the Swiss and with the Europeans tomorrow could be a major issue.
Meanwhile, we did hear, Kaylee, from the Federal Reserve and the U.S. Treasury Department. I'm curious what kind of further statement we could expect to hear from Washington, D.C.
Well, we aren't necessarily expecting anything tonight, Lisa, but yes, we did get that joint statement out of Fed Chairman Jay Powell and Treasury Secretary Janet Yellen saying they welcome the announcements by the Swiss authorities today to shore up financial stability. They then went on to say that the capital and liquidity positions of the U.S. banking system are strong and that the financial system is resilient, which just speaks to the fact that here on this side of the Atlantic, we are still on watch for continued turmoil in banks, whether we will get deals from the failed lenders, Silicon Valley Bank and Signature Bank, what happens with First Republic, which market confidence on Friday did not look like it believed that $30 billion in deposits from 11 large banks would be enough. So there remain questions here that regulators still are monitoring. We are, of course, on watch for anything out of Capitol Hill. Nothing yet from the lawmakers in D.C.
We've been doing this now for 2 weekends. Lisa, here we are on weekend number 2.
Yeah, although this one feels a little bit different, given that this is a globally systemic bank that has a pretty significant response from Swiss authorities.
If you are just tuning in, welcome to the programme. A $3.25 billion deal, UBS agreeing to buy Credit Suisse. Francine, you've been at the heart of this conversation, not just the last week, but for much of the last decade. Plenty of questions. How controversial is this?
Well, it's pretty controversial if you're a bondholder and you got wiped out if you're AT1 bondholder, but actually, if you're a shareholder, you get a little bit. So I think many questions from the markets, many questions also from the point of view of what happens to all the Credit Suisse assets being absorbed by UBS. So first of all, UBS asking a lot of guarantees, not only for FINMA, but also from the S&B in terms of liquidity and loans to make sure that everything's in order. What did they see that we hadn't seen in Credit Suisse? And then the second question is what happens to the investment bank? They say they'll wind it down. Do they put in a bad bank? What happens, of course, to the Swiss bank? If you have some kind of super Swiss bank, which is UBS and Credit Suisse together, what do regulators say about that? So many questions for the moment. The markets, I think, are a little bit safer maybe than they were a couple of days ago, but we'll see how they open tomorrow. But going forward, many, many questions of how we got here so quickly and, of course, what this means going forward.
Francine, how stunned do you think leadership is at Credit Suisse? Only days ago to be sitting there with you in the studio in London, looking towards the future, talking about a better Q1, and then to face this weekend.
I have to say, John, we were in a press conference with the SNB president, with the Swiss, of course, the finance minister, with the two chairmen of UBS and Credit Suisse, and they all look stunned. I don't think anyone was expecting it quite to happen so quickly. Many times also the Swiss finance minister is saying, look, this is not a bailout, this is a corporate solution. You're right. 5 days ago, no one thought it could happen so quickly. We had heard rumors that this longer term was going to be difficult for Credit Suisse, so that there was going to be some kind of breakup. But I remember at the time people saying, look, this is 2, 3, 4 years down the line. If that, I think being stunned, certainly if you're Credit Suisse and you wonder what that means for your job, but also if you're UBS, you've absorbed this bank and then you need to figure out really how the bits fit all together and what happens going forward. I did ask the chairman many times, and actually there were 4 questions at the press conference, how many cost cuts, how many job losses, and that's something that he said it's too soon to answer.
Hey, Francine, wonderful work over the last week. Really looking forward to your coverage this week and the week ahead. Francine Lacqua alongside Kelly Knight and Mike McKee. Let's go through the numbers. Here are the numbers. So the Swiss bank, UBS, paying 3 billion Swiss francs for Credit Suisse. That's $3.25 billion. This includes some big government involvement. Let's be clear about all of that. Think about what this bank was worth on Friday. 7.4 billion Swiss francs at the close of trading on Friday. This is what the government has thrown in. So the Swiss National Bank is offering a 100 billion franc liquidity assistance to UBS. The government is granting Lisa a 9 billion franc guarantee for potential losses from the assets UBS is taking over.
This felt desperate, especially because we got the tick by tick over the weekend of what some of the parameters for negotiations were. One of them was that UBS was to buy Credit Suisse for 1 billion Swiss francs, and Credit Suisse pushed back and said that absolutely is almost punitive. So then as this evolves, not only did some of the things get stripped out, like credit default swap guarantees in terms of things and that were pretty unconventional, but the backstop that Credit Suisse had to require by the Swiss government is raising probably more questions than anything else at this point.
We've got a fantastic guest alongside us in the studio this evening, Bob Michael, the CIO and Global Head of Fixed Income at JPMorgan Asset Management. I usually say good morning. Good afternoon.
Yeah, I wish I wasn't here tonight.
This is different. I think we all feel the same.
Makes
a lot of people sitting at home would rather be watching a basketball or something, but they're not. They're talking about this. You need to translate this for us all. 16 billion Swiss francs worth of risky notes go to zero. What just happened there?
Well, for those of us in the bond market, we always knew AT1s were the fulcrum in the bank's capital structure. And we always wondered if there ever came an event which would cause those bail-inable bonds to be bailed in, how would they be bailed in? How would they be treated? Now we know. They were bailed in and then zeroed. They actually are below equity holders in the capital structure, which is not something I guess most investors would have assumed.
What does that mean for a $275 billion market of these instruments that are owned by pension funds and other investors around the world?
Well, you have to go back and reassess everything in the European bank capital structure. Why was it put in there? You had the TLAC issuance, you had the MREL issuance. All of these things were designed to add capital buffers. So, yeah, look, we're all big investors. We get it. Our bonds were bailed in. They were zeroed out. But you have to wonder, are you being compensated enough for these risks?
So let's take that a step further. Was what we just saw enough to stave off some of the concerns, some of the potential selling activity that we can expect to see tomorrow at European banks, particularly those that have more wobbly structures?
I hope so. I think the regulators in Europe and Switzerland, and I think those in the U.S., when you circle back a week ago, responded with a speed that we've never seen before and cut a lot of red tape and stopped this in its tracks. And I think we just have to accept that the banking system is a fractional reserve system. 3 years ago, we saw the benefit of that, right? You had liquidity injection into the system. It was extended into the economy. There was a multiplier effect. It worked. Now we have the reverse happening. You had a rate shock rippling through the system. You have quantitative tightening sucking it out of the system. And what we're learning is the multiplier effect works in reverse.
Hearing from the UBS CEO, Ralph Hammers, right now. Here's a headline for you. Inflows last weekend show we are a safe haven. They were getting the inflows. We know where the outflows were. Bob, it's interesting you talk about the banking model. It's been interesting to me for the last week to hear people describe the way banking works, that you are borrowing short, you are lending long, and you were booking the difference in between to make a profit, and people turn around and say, well, that sounds risky. What were they up to? Sounds a bit naughty. And I sat there thinking, well, that's the model. That's what a bank does. And I think a lot of people have slowly worked out what banks do. Bob, outside of our world, and they've suddenly realised actually there is an FDIC limit, and that maybe I won't be made whole after 250,000. And we've created a two-tier banking system in America. Now, what's odd about that is we can sit here and say, well, that was always true based on the rules. We kind of knew this already. A lot of people didn't know that, and they know that now to be true. Bob, how have things changed for this banking system in the last 2 weeks?
Well, I think there's a greater awareness of how bank models work, and that as you walk around and see where your local, regional, or even money center bank has financed projects in different communities, you start to think, will they get their money back? Are they using my deposits for that or not? I still go back to we're a fractional reserve system. That's how we're set up for. We're seeing the downside now, but there are benefits to the upside. It's that extension of credit, that money multiplier effect. That's what got the economy restarted 3 years ago.
Last week, you talked about the tip of the iceberg in a conversation with John.
I didn't expect this, though. I want to be clear.
Okay, but it wasn't necessarily the tip of the iceberg with the banking system. It was the tip of the iceberg in terms of the effects of tightening, of monetary policy becoming more restrictive. I'm curious to understand whether you have perhaps accelerated your expectation for the potential credit losses that could be incurred, especially as some of these regional banks truly retrench.
You could sit there and say, in theory, this shouldn't have happened. Do you go after the most heavily regulated, capitalized industry on the face of Earth, which is banking, and then you go into the Swiss system, and you've got a bank with over 13% common equity tier 1. So it's telling me that the long and variable, the cumulative and lagged, they're catching up fast. And they're biting in ways that maybe we were somewhat naive in expecting. So I think this is still the start of that taking hold. For sure, it's going to slow growth. For sure, it's going to bring down inflationary pressures. I'm anxious to see what the Fed does on Wednesday.
I understand you've gotten quite a few calls from clients. What's their biggest concern right now?
Well, of course, they want to know, what do we hold in their portfolios? How did we put it in there? How did we research it? Then you get a lot of questions about what they held elsewhere with other managers or bought internally. There's a concern out there. I think what you're pointing at is this is another layer of credit conditions tightening. And last time I was on, I talked about the 3 layers with John. The first are the central banks, right? We know they've raised rates at the fastest rate since the 1980s, tighter credit conditions. The second are the banks. You look at senior loan officer surveys. Credit conditions have tightened dramatically there. So that's the second layer of credit tightening that's going on. Then you look at the non-bank the non-bank lenders. That's me. Those are people in the markets. And when you think about the size of these markets, we went back, we looked at the bank loan market, the high yield market, the private credit market. In 2007, it was 1.4 trillion. Today, it's 4.2 trillion. And what you're going to see is a further drawing back of credit there. So the Fed doesn't have to raise rates on Wednesday. The market's going to do the credit tightening for them.
We're going to take this conversation a step further and continue this conversation in just a moment. Bob Michele of JPMorgan Asset Management. There is an analyst call going on right now with the UBS executives, the CEO saying the integration of Credit Suisse to take 3 to 4 years, also pointing out they will pause their share repurchase program. The latest headlines from UBS just moments ago. Coming up in the next hour, looking forward to this conversation with Greg Peters, the co-CIO at PGIM Fixed Income from New York. This is Bloomberg.
Yeah, it is a bailout, and it's a bailout, and you heard the minister say, it's a bailout because they're dealing with a systemically important bank at a time of market turmoil. Now, of course, you're going to always be dealing with a systemically important bank at a time of market turmoil. That's by definition. question what happens when you have a systemically important bank in trouble, but they just don't want to use that phrase.
Mohamed El-Erian, right on the money in the last hour on this programme, in conversation with Lisa Abramowicz and Jonathan Ferro. Lisa, I've got to say, they're allergic to that word right now. They hate it. They want to come out in a news conference saying that's not what this is. This isn't what it is. It's not a bailout. You heard it from the president this week as well.
My favorite thing is that all of the regulators come out and say this is not a bailout, and then all of the market prognosticators come out and say that absolutely is a bailout.
Looks
Pretty
like
much one after another. It looks like one. It smells like one. It's money going in to protect against risk in order to stave off the contagion. Whether they should or shouldn't do it is one question. Whether it'll work is quite another.
Last weekend we were dealing with SVB and Signature Bank. I'm not sure we even knew that Signature Bank was about to fail until we were told it had failed last weekend. This weekend we're dealing with Credit Suisse. UBS agreeing to buy its longtime Swiss rival for 3 billion Swiss francs. Said it a little bit earlier on, worth mentioning again. Think about where this closed on Friday. Not 3 billion Swiss, 7.4 billion Swiss, and we thought that was low. What a price cut they've got by the end of the weekend, and this gets thrown in as well. The SNB offering a 100 billion franc liquidity assistance to UBS, the government granting a 9 billion franc guarantee for potential losses. Now, all of a sudden, if that guarantee gets used, then what do you call it?
Well, exactly. And I think that that's the provision that people are looking at. In the meantime, you've got a 16 billion Swiss franc a portion of bonds that have been completely wiped out, really resetting the rules for a $275 billion market in Europe and throughout the world. It raises some questions also about what they saw under the hood of Credit Suisse that raised all of the back and forth that was reported all throughout the weekend that started for a 1 billion Swiss franc price tag that UBS was willing to pay for Credit Suisse.
Lucky to have Bob Michael with us in the studio. JPMorgan Asset Management's Bob Michael with us right now for a few more minutes, Bob. Let's talk about this. 2 weekends running, officials come out and try and restore confidence. Does this inspire confidence or make you nervous?
It gives me a lot of confidence that they're willing to respond this quickly and put in place decisions that help stabilize things, at least for the time being. And we're talking about, what was the value of Credit Suisse or not? What does UBS know? Maybe it's UBS doesn't know enough to make a decision. So it wants something in place that could protect them from what they'll learn. There's close to a 5-year period that this execution is supposed to take place. They're talking about having it done by the end of 2027. So I give the regulators, the official institutions, a lot of credit for stepping in, and I give UBS a break here because, come on, they had a couple days to do due diligence.
Perhaps it gives you some comfort. Does it make you optimistic? What would it take for you to feel a bit more optimistic of just not necessarily a significant downturn and potentially inflation that just naturally disinflates?
It makes me more confident that we're headed to recession, and that's unfortunate. But I think what we're seeing now is actually a little bit ahead of schedule. I wouldn't have expected to see this yet. I wouldn't have expected it to happen in the banking system. I think when you go back and look at it and you realize, well, it was depositors, they're facing a lot of different pressures. You could get there. That's what you would expect when you have central banks taking away the punch bowl. So I think when we've had this period of tremendous liquidity and stimulus sloshing around the system, which we needed to get us through pandemic, and we always knew when we got to the other side it would be painful to withdraw it. We're going through that now, and that washes out the unsustainable excesses.
Given that, in your view, this accelerates, this brings forward a recession, how does it change the contours of that recession at a time when you're going to see a lot of these regional banks potentially tighten credit conditions for commercial real estate as well as for personal loans?
It depends what the policy response is, and I'm expecting the Fed to cut rates in September.
September, that's soon?
Yep.
The beginning of a cycle or just a shift back?
I think it's to stave off recession. And there are so many things. You can look at the inversion of the yield curve. You can go back and look at one of the things that Jay Powell told us was their favorite indicator, the 3-month versus 3 months, 18 months forward. That inverted at the end of last year. And generally, once that inverts, you have recession about a year later. So that puts recession on track for end of this year, which means Fed easing always comes before that, September.
So here's the question. Some people might be listening to this thinking, I missed my chance to get a 2-year with a 5 handle. Might have missed it at 4. Do I need to grab it now before it gets to 2?
I wouldn't wait too long.
Really?
Yeah.
You think they could cut back that much?
As I said in the past, I think the entire yield curve will be 3% over the summer. And you said we're almost there now. Look, there's got to be some backup, right? A lot of government bonds were bought before the weekend as some downside protection for risk. And there's got to be some give back Monday, Tuesday. I keep half forgetting it. Sunday.
Seriously, us as well. What does that mean then for longer duration credit, longer duration bonds at a time when we're still dealing with inflationary pressures that people said were so much stickier than people thought?
I think that's in the rearview mirror. As Peter Cheer said before, you look at oil, it's come down a lot. That's going to be pretty disinflationary. I think this is going to cause business and households to pull in a lot of their saving. Things will slow down, and then you're going to start to hit the cumulative and lagged impacts of the very aggressive monetary tightening that started just about a year ago. As I said, this is not atypical, and after all the liquidity that was pumped in, it's probably needed.
The 1-year anniversary of the hiking cycle, March 16th. Here we are on March 19th. I'm still getting accustomed to the fact we're here on a Sunday evening.
I think a lot of
people... I walked in today and I said good morning at 2 p.m.
I might have done the same thing.
2 p.m, good morning.
Good morning,
people on the door were like, who is this guy?
I think that people see you and they just expect
No,
you to
someone's
say
already
good
asked,
morning,
can you do good evening? And
yeah,
maybe a little bit later. Stay tuned. Bob Michael, that was
good
great.
Evening, good evening.
Great to see you. Thanks for being with us. Bob Michael there at JPMorgan Asset Management. The coverage continues. We'll be here until about 7 p.m. Eastern Time. 6:40 Eastern Time. We'll catch up with Steve Pagliuca, the Senior Advisor at Bain Capital. Live from New York City this evening, good evening, and here we are on another Sunday at the cliff edge, looking for authorities to do something about the financial system. And here's the deal. UBS agreeing to buy Credit Suisse for 3 billion Swiss francs. Lisa, the controversy around this deal, there are many points. One aspect of it, the $17 billion of risky bonds that will go to zero. There was an analyst call still ongoing. The CEO, Ralph Hammers, asked about this, and he said the Swiss regulator took the decision on AT1.
FINMA basically decided what the protocol was. It has not really been tested before, as Bob Michael was just explaining. They didn't know where they stacked up with these particular bonds, these contingent capital instruments, where they stacked up versus equity, and they found out it was below the equity. And this is going to change the scenario for a lot of people who own this debt currently.
Where does it leave this market now into tomorrow morning and beyond?
A little bit lower or a lot lower. I mean, you have to imagine that people are going to look around and say, what kind of risks do I have to bake into this versus equity valuation? And am I getting compensated for it? That said, do we get some more clarity about what goes into that and how stable other banks are to avoid a scenario like this?
There's tons of complex issues here. Michael Hartnett at Bank of America at the end of this week on Friday made it pretty simple. He said bank emergency borrowing, tighter lending standards, small business credit crunch, Lisa, higher unemployment. Base case for Michael, base case for many others too.
Basically saying bringing forward a recession at a time when you're suddenly seeing the lagged effects of tightening really take hold. This, to me, is really the ultimate consequence of this. How long does it take, given that you might see potentially some kind of response from different kinds of regulators?
Doesn't someone stand up around the table at the FOMC on Wednesday and basically read out the same quote? Something similar to it?
Then you'll get a lot of pushbacks. In other words, banks raise their hand and you say, here's some kind of response. I mean, this is really the dilemma.
Live from New York City, the conversation continues. Stephen Bigger is going to join us a little bit later from Argus Research. Hi from New York City, welcome to the programme. What a week for Credit Suisse. Earlier this week, the CEO attempting to inspire confidence.
I'm fully convinced of the strategy. We are executing at pace. We have the right team. And, that's why we said in October it needs radical change. The bank needs to be changed. And we said it's a 3 years transformation. And you can't come after two months and say, look, why is not everything done?
Only days later, the bank's top shareholder doing very little to allay concerns.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in.
Following that, the stock started to sink. We got a public display of support from the regulator and a major central bank lifeline. Not enough to prevent Credit Suisse from coming into the weekend fighting for its future. And it all ends like this.
This solution is the takeover of Credit Suisse by UBS. The Federal Council welcomes this takeover and is supporting it by guaranteeing the framework conditions necessary for its success.
Lisa, this is the outcome that everybody feared.
And this is really raising more questions than it is answers. Bill Lee, over at the Milken Institute, chief economist there, saying, unfortunately, continued references by Swiss authorities and bank executives to the U.S. banking turmoil raises concerns that intrinsic problems among Swiss banks are not being addressed. There is a question of what the unknowns are at a time of so much speculation.
Most people have come on this show over the last few weeks, dare I say the last few years, and pointed out the problems with Credit Suisse. We used to talk about Deutsche Bank being the poster child for problems in banking in Europe, and it's been Credit Suisse for a number of years now, hasn't it? How can we sit here and seriously say this was about what's happening on the other side of the Atlantic in the United States?
Some might argue that it pushed it to a threshold. It pushed it to a brink at a time when people have been looking around and wondering where a crisis in confidence could hit next. If you're wondering where a crisis of confidence could hit, Credit Suisse is a prime poster child for that. Now, that said, there was no problem until there was. They said that their capital buffers hadn't been breached. All of the reassurances that all went out the window when we heard about some $10 billion of outflows on a daily basis at the end of last week, as Financial Times reported earlier.
As we've covered this story through the week, you and I have both said, Tom has as well, that we all know some super talented individuals at this institution, at Credit Suisse. It's going to be a really difficult time for people who work at that bank. And I always get frustrated when we read those headlines. 10% of the workforce is going to go. 10,000 people. Real people. There's some serious overlap between what UBS is taking on and what they're absorbing. And I just wonder what those numbers, Lisa, are going to look like through the next, what did he say, 3 to 4 years to fully absorb, integrate this institution.
And how do they keep all of those talented individuals that made the bank successful at the times when it was successful? These are all the questions that UBS has to work through now at a time when it's dealing with bringing together the only major Swiss bank now, because it is really now one kind of banking town, a nation that is known for its financial system.
The coverage continues, special coverage right here on Bloomberg TV and radio. If you are just tuning in, welcome to the programme, a special edition of Bloomberg Surveillance with Lisa and myself. A 3 billion Swiss franc deal, UBS agreeing to buy Credit Suisse. Some important numbers in this, though. Friday, think about where the market cap was at the close. 7.4 billion Swiss francs. The deal, 3 billion. We got absolutely hammered over the last year on that stock, and yet still not enough to entice UBS. They had to come even lower. Here are some other numbers for you. From the S&B, the Swiss National Bank, they're offering a 100 billion franc liquidity assistance to UBS. And a bit of controversy around what happened to AT1. This risky debt. Lisa, the government granting a 9 billion franc guarantee for potential losses from assets the UBS is taking on. We've talked how quickly this has happened, a single weekend. I understand from reporting the talks actually started on March 15th. And then it got really serious over the weekend where they felt like we needed to find a deal imminently, immediately. UBS was clearly nervous about inheriting some legal and regulatory risks around these assets and around this institution. Is that number big enough?
I think right now what people are looking at is whether that 16 billion franc allotment of AT1s or capital contingent bonds can actually absorb a lot of those losses. But it really goes to this bigger question. What did UBS see under the hood that made them raise the price and raise the guarantees, raise their threshold for what they were going to be okay with when they were speaking with Swiss regulators?
Joining us now, I'm pleased to say, is Mark Nauer, the senior analyst at Danske Bank. Mark, I'll make it simple and you tell me what you think. Has UBS got a bargain or taken on a problem?
I think that's, of course, the $1 million question at this point. I think the truth is that there's simply too many unknowns to truthfully say anything about whether it's a bargain or whether they're overpaying. But I think at least with the AT1 write-down that we're seeing and a relatively low share price compared to the market value by Friday, as well as the guarantees that they got from the Swiss government, I think they've got a lot of security cooked into this deal. So I'm having a pretty hard time seeing that it'll turn into a disaster for them. But there's a lot of things that I've had a hard time imagining during this week that's happened. So I wouldn't call it a confident statement.
Given the fact that UBS will be the lone major global banking institution of a nation known for its banking institutions, doesn't this implicitly have the guarantee of the entire Swiss government behind it?
Are we talking about the AT1s now? Or we're talking
UBS.
More generally?
UBS in particular, once it's assumed its Credit Suisse acquisition.
Well, I mean, I'm not sure whether we're talking about the AT1s or what we're talking about specifically, but I think we've got a lot of guarantees. They'll, of course, have to take the first billions in losses from any legacy cases that Credit Suisse potentially hasn't popped up fully yet. So they'll have to take some of those losses. But other than that, it seems like the Swiss government will most likely be underwriting those risks. So to a large degree, I agree with you that there should be a lot of margin of safety cooked in before we got UBS bidding for more than what was the closing value of the stock on Friday.
Mark, from your perspective, as you look around to other European banks, are there other vulnerable institutions, particularly in France, that came under some selling pressure last week that you're really watching closely at the open tomorrow?
Of course, I'm mostly concerned about the Nordic banks, and I would say I'm not paying particular attention to any of those with who suffer very little similarity to the Credit Suisse case. If we're looking beyond the Nordics and as you mentioned, France, naturally there's going to be some banks down there that we know have been heavily involved with some business with Credit Suisse during the years. Having said that, however, I also think that there's been a long way leading up to the collapse that we're seeing unfold of Credit Suisse right now. So I think that to the extent that any bank had any meaningful exposure, they've had ample time to cover it. And I would assume that they've done so. So for me tomorrow, it'll be more about looking into how the market absorbs this and looking into particularly how the AT1 market is able to absorb this deal.
Mark, a week ago, not even a week ago, this was the trade in Europe. It was long European banks. We had guest after guest come on this programme say, get long, great story. Rates are going up, economy's doing better. This is where you want to be. We saw massive outperformance in that sector. Mark, what's the argument for that sector now?
I think that narrative has at least been put on hold, and I think that'll be for a very long period until we restore some confidence in the European banking sector. I still think this Credit Suisse case is in many ways quite unique, and it's not like we didn't know there was going to be problems or that they weren't suffering some challenges. But so from that perspective, I see relatively little spill over directly to European banks. But naturally, a lot of the tailwinds that have led us to have a positive view on the outlook for European banks over the foreseeable future seem to have been put on a long pause and maybe even have reversed altogether.
Hey, Mark, wonderful to hear from you. Mark Now there of Danske Bank. Let's see how UBS trades tomorrow. And I'm not just talking about the equity, Lisa. Let's see how the whole universe of UBS securities trades tomorrow.
The people I'm talking with are all watching the credit default swaps of UBS, which have been increasing over the past couple of trading sessions. They want to understand when those credit swaps increase, when the price increases, it's the price to protect against a default. That is not good. And people are wondering whether they have assumed the risk of Credit Suisse, that the guarantees of the Swiss regulators, have they been enough to prevent that from happening?
So let's assume this is a resolved issue. Not sure it is, but let's assume it is. It's a resolved issue. We need to talk about the ripples off the back of this story, and we need to discuss the unresolved issues on this side of the Atlantic. It's only this week we had 11 banks band together and park 30 billion deposit. There you go, at First Republic. I think we need to keep going back to this. On that same day, Friday at the close, that stock was down 33%. First Republic. 2 Mondays ago, it was a $123 stock. At the close on Friday, it was $23.
You have medium-sized banks begging the FDIC in the United States for a bit more reprieve to get some sort of insurance against the limits that they have on depositors so that they can go back and say, you know what, even if you've got $2 million in our bank, it will all be protected should we go under. Not things you really want to be saying to people. The larger point, though, is that these banks are probably seeing withdrawals. They're probably seeing deposits go to the major banks, just like Mohamed El-Erian was saying. In that case, what is the consequence, both on the side of these medium-sized banks as well as the large banks, that suddenly are sitting on billions and billions more deposits?
My question would be, how do you restore confidence without changing policy? What can you do? Secretary Yellen, I think, had a really difficult time in front of the Senate Finance Committee this week. Couldn't answer the question. How do you resolve this issue? Now people believe there is a two-tier banking system in the United States of America and their deposits are safer in one place and not in the other. How do you resolve that?
A lot of people are saying the only way to resolve that is to tighten regulations on some of these medium-sized banks to make them more in tandem with the larger banks. Because right now, how much is this a banking crisis and how much is this a banking regulation crisis, which is exactly what we heard from Terry Haynes over at Pangea Capital as he was putting together some of his thoughts. This, to me, was a failure of regulations that even flagged concerns as we see the reporting. So at what point do they have to move on that before they can restore confidence?
We'll continue this conversation coming up shortly as Seema Shah, the Chief Global Strategist at Principal Asset Management, as we guide you towards the Open in Asia and towards trading next week stateside. I believe equity futures open up in about 18 minutes from now. Looking forward to that from New York. This is Bloomberg.
People are doing something that probably is not rational, but totally understandable, which is they're moving deposits. And where they're moving deposits out of? The smaller and the medium-sized banks into the larger banks. And that dynamic isn't going to stop overnight. Neither are the losses that are being incurred. You've wiped out 17 billion of AT1s. There's going to be a lot of repricing in the credit segment. So this is going to be pretty bumpy going forward.
We've been really lucky this evening to catch up with some fantastic guests, including Mohamed El-Erian there, following the deal between UBS and Credit Suisse for 3 billion Swiss francs. A bit of news crossing the Bloomberg moments ago. Katie Lyons for us down in DC. Kaylee, what have you got?
Well, it's related to First Republic, John. Downgraded again when in terms of its credit rating by S&P Global Ratings to B+ from BB+. Remember, it had just been cut to junk days ago. The analyst over at S&P referring back to that $30 billion in deposits put into First Republic by 11 larger banks last week in an attempted rescue, basically saying that they don't think that is a long-term solution. They say attracting meaningful deposits will be difficult, constraining the bank's business position. And this does seem to be somewhat in line with the view of the market, considering after that rescue was announced, we saw First Republic shares down 33% in the Friday session. So now there is a massive question about the future of this bank, as it is one of those regional lenders that has struggled with deposit outflows in the wakes of multiple bank failures here in the U.S. And this is one we're going to be watching to see if it gets put into a receivership potentially, or if it needs to be bought out by another bank, similar to what we are seeing across the Atlantic today, guys.
Hey, Kaylee, on the latest. Kelly Lyons there down in Washington. Kelly, thank you. That line there, Bramo, is absolutely scathing, brutal. Attracting meaningful deposits will be difficult.
This goes exactly to the question that you just asked, which is how do you restore confidence in this banking system that is below the top tier of banks? And that is basically a credit rating agency agonizing over that question and twice in a row in 2 weeks saying, not looking good, and still not looking good.
The Standard & Poor's taking shots. Let's take a shot at the credit rating companies. These banks were IG.
Sure.
A week ago, 2 weeks ago, 10 days ago.
The banking industry runs on trust. Ultimately, it's when you put your money in a bank, you can get it back out again when you want it. When that trust is broken, how does that get it sort of spiraled through the system in a way that sort of feeds on itself? And that, I think, is what regulators are trying to stave off. And we're asking the question, is it enough?
Let's keep building on this. If you're just tuning in, welcome to the programme. Lisa and I have been talking about this for the last 2 hours together with the team. Been talking about it all weekend, the potential for a deal, just the way this came together. First it was 1 billion, then it was 2. Then it turns out to be 3. UBS agreeing to take over Credit Suisse for 3 billion Swiss francs, way below its market cap. at a close on Friday of 7.4 billion. Joining us now is Seema Shah, Chief Global Strategist of Principal Asset Management. Seema, I said this to Bob. Usually it's good morning, it's good evening on a Sunday. Do you feel more or less confident after this weekend?
Oh God, I think we all closed our computers on Friday worried about what could come out over the weekend. I don't feel more reassured. I feel a little bit concerned about what this week is going to bring.
Seema, in about 13 minutes, we're going to see the cash futures open for U.S. stocks. I'm wondering what you're watching for as markets open to understand the tenor of how this is being received.
Like you just said, the banking sector is really, it runs on confidence. We just need to see what the sentiment is out there. If you're going to continue to see moves away from smaller banks into bigger banks, we're going to see what happens, of course, to treasuries. This is really about investors, or actually anyone, in fact, thinking about where is safe, where are the safe havens out there. So if you're going to see a continued rally in treasuries, that is going to be a concern in terms of the wider backdrop and what the implications are. Broad risk assets, we need to look, again, of course, what's happening through the European banking industry. Where is the confidence? Has this deal actually ruined confidence even further, or has it propped it up? I don't think it's very clear at this stage.
What do you think, your view, how has it changed over the past couple of weeks? We were just talking with Bob Michael of JPMorgan Asset Management. And he was saying he's brought forward his expectation for how quickly recession will take hold. What's your sense of what's changed?
Yeah, we were negative coming into this year. I think like many people out there, we were expecting recession to come through in the second half of the year. We had expected the Fed and other central banks to continue raising rates, then keep them on hold for the remainder of the year. Now, there are certain segments of that have changed. We have, of course, become a lot more pessimistic. It does seem like recession potential has come forward a little bit. And in terms of Fed tightening, of course, I don't think they're going to go as far as we had expected. But you have to think the reason for Fed tightening was to tighten financial conditions. Whether the Fed tightens or not, financial conditions will tighten from here. This banking crisis, the tightening of lending standards, this is all going to feed through to the same end result, whether the Fed goes on Wednesday or if it doesn't go.
I'm not saying we're there. I'm not saying that this is a major crisis. Yeah, I'm not saying any of that, Seema. I just want to reflect on what's addressed crises in our history. Whether it was Draghi saying whatever it takes in the Eurozone debt crisis 10 years ago, back in 2012, or whether it's the Federal Reserve in the pandemic coming out and pledging to buy credit, both of them, the ECB, the Federal Reserve, turns out didn't actually have to follow through. They just had to say certain things. What needs to be said in the next week? What would you want to hear that would change your mind on your less constructive view on this market?
So I think this is a really tough time, actually, because you do run the risk of the Fed or central banks come out and say something about some kind of help they're going to provide. And I think because the market is still in two minds about how this is going to pan out, you do run the risk of actually creating a little bit more panic. And people start to think that actually the situation is worse than it is. I think at this stage, as Lisa was just saying, maybe something about the insurance of deposits, above that 250K in the US would go some way to at least stemming a lot of the problems. I think that this is, at the moment, for policymakers, is just wait and see, because we're not quite, as you said, at the point where we can very clearly say this is going to be the next banking crisis. I think there's a window of opportunity here, but a lot of it is just going to depend on regulators and, of course, how these various deals are. The other thing that we need to know, of course, is that we're not going to unearth something else in the next week or two. We all saying that the three banks in the US were unique cases, Credit Suisse, very unique case as well. At some point, people start to ask how many unique cases add up to contagion. So I think that's what we also need to see is, a couple of weeks of nothing being unearthed. And I think that would also reassure markets a lot.
Do you think that on Wednesday, if Fed Chair Jay Powell raises rates by 25 basis points, he will help contribute to gaining confidence that there isn't another shoe to drop? Or do you think that he will undermine whatever's been created?
I think that if he were to raise by 50 basis points, if he were to stay on hold, I think that would undermine confidence. Going by 25 basis points, to me, just seems like the right path at this stage. Telling markets that, look, yes, things are difficult, but we are not overly concerned. We know that there's an inflation problem out there, so we think that we have the ability to contain financial instability and this price instability. I think that's what we need to hear from Powell. But look, so much depends over what happens over the next 2 days. How does the market respond to the news that we've got over the last 24 hours? That is really, we talk about data dependency. Well, really now central banks are incredibly data dependent.
Seema, thank you. Seema Shah of Principal Asset Management. I go one further. Data dependent, not just the economic data. It's the stock prices of banks, isn't it?
That's what I was going to say.
What happens with the debt?
What data are we going to get over the next couple of
Precisely.
days? We're going to get the response in markets, and how much are they going to trade off of that, or basically say, 25 or nothing? And then what kind of moral hazard does that raise? When you're supposedly stripping out the supervisory function from the controlling inflation function, and you have to basically compromise the fighting inflation function to deal with situations and pitfalls perhaps in the supervisory front.
People have lined up for 12 months saying that this chairman of this Fed does not want to be Burns, wants to be Volcker. We've asked this week, who wants to be Trichet and hike into a crisis? Who wants that?
Well, Niall Ferguson basically wrote this column talking about how he is not Volcker and that he has not had that same kind of consistency, but he also has not seen inflation come down in the way that Volcker was able to see it come down before he stopped. So you can play both sides of this. It's such a difficult moment, and it's very hard to come up with the correct historical analog.
I like how Ferguson opened that piece, to break or not to break.
Exactly. That was fantastic.
Yeah, that's the question this week. Coming up, 6:40 Eastern Time, we'll catch up with Steve Paliuka, the Senior Advisor at Bain Capital Private Equity. In the next hour, Greg Peters of PGIM. We'll talk about that in a moment. In about 5 minutes from now, US equity futures are going to open. We'll get to that open for you, break down some of the price action. We'll do that with Greg Peters of PGIM. Lisa, as we comb through this $3 billion deal, 3.25 billion US deal, UBS-Credit Suisse, what's the big question for you?
The big question for me really does stem from the 16 billion francs of debt, the subordinated debt, just simply because it raises some serious questions for a $275 billion market that hasn't really been tested before. That's my main one. And my other one is just, what did UBS see that we don't know to sort of draw the hard lines that they did on this deal?
And how do you value a bank in Europe at the moment? This one closed at 7.4 billion francs on Friday, and there's a deal on Sunday for 3 billion.
What's your big question?
My big question right now, the US side of things, not the Europeans. Easy to take shots at the Europeans, always is. What are they going to do on the insurance limits of deposits in America?
By the way, it's easy to take pot shots in the US too, just saying that. And that's what I think a lot of people are doing. But you're right, that is going to be a lot of questions.
I've built a career on taking shots at Europe.
Okay.
Just trying to shift the focus elsewhere for a moment. Greg Peters of PGIM, up next.
This solution is the takeover of Credit Suisse by UBS.
Yeah, it was a bailout. There's 9 billion of contingency credit guarantees there. There's 100 billion of liquidity support.
I can reassure the members of the committee that our banking system is sound.
I was around in 2008. I think that the banking sector is currently in a much, much stronger position than where it was back in 2008.
Americans can rest assured that our banking system is safe. Your deposits are safe.
This is a special edition of Bloomberg Surveillance with Jonathan Ferro and Lisa Abramowicz.
Live from New York City, coming up, avoiding a weekend cliff edge, UBS agreeing to buy Credit Suisse. The Swiss government brokering a deal for more than $3 billion as officials worldwide race to restore confidence. From New York City, good evening. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Our special edition of Bloomberg Surveillance continues. Bramo, let's talk about futures. We open up positive, a third of 1%.
So we asked the question, was it enough? Right now, people are tentatively feeling enthusiastic. The night is young. We shall see how it goes. But there is this question of, does this restore risk appetite, given the fact that you are getting such significant intervention from federal authorities?
I asked you at the top of the programme, do we have a solution? Or have we created a monster?
And the monsters that we're talking about, when we discussed what that was, is it the moral hazard? Is it the perception that there's a bigger problem than perhaps people were aware of? Or is there this larger banking crisis or a larger banking challenge that people haven't fully articulated that's underpinning some of the emergency steps?
How much would you read into early futures pricing
Very little.
This evening on a Sunday off the back of this?
Very little. I think that what people are going to be looking for is Monday morning, in particular European banks. How do they trade? How much contagion risk is there? Or do people view this as a uniquely Credit Suisse issue that's been going on for quite a while?
Let's get to the team coverage. Joining us, Sonali Basak, our Wall Street correspondent, Michael McKee on the central bank response, Katie Lyons in DC, another downgrade for First Republic we'll get to in just a moment. Sonali, talk me through the numbers for the people just tuning in for UBS taking over Credit Suisse.
There are a few things to remember about this deal, and it tells you just how much a bank is worth under a time of stress, John. That is an asset to equity ratio of more than 170. This is a deal that brings you to the share price of less than 99% less of what Credit Suisse was worth at its 2007 peak. This has been a slow decline and then an abrupt ending for Credit Suisse. Now, remember, this is also difficult for UBS, and you have some things to watch here. They are going to plan to cut $8 billion worth of costs. This is a tremendous impact on the job market, particularly investment banking and possibly wealth management across the globe as well, given that these firms will seek synergies. Then there are the investors to think about. That's a lot of money at play there. You've been talking about it all evening, which is the fact that these AT1 bonds will be wiped out. And remember, that makes you look at the entire market for European CoCos. Remember, when you think about that, what my sources are saying, you have to think about how much this increases the cost of funding for the European bank market. And by the way, some of those are systemic global banks, so the cost of funding overall, that has a ripple effect to look at. Lastly, keep an eye on the CDS prices. They've already blown out. UBS is now acquiring an investment bank that it admits is a large liability, which means that government backstop of taking on $1 billion worth of initial liabilities was needed before this kind of deal would happen.
Kayleigh, meanwhile, when Sonali talks about potential contagion, we have gotten some word about what the next steps could be for First Republic or what the potential risks are. What's the latest?
Well, First Republic was downgraded again by S&P Global Ratings, getting cut even further into junk. Basically, that ratings agency saying the $30 billion in deposits it received from 11 large banks last week and an attempted, and I stress attempted, rescue is not going to be a longer-term solution. S&P believing it will be difficult for them to attract meaningful deposits, which constrains the bank's business position. And this speaks more broadly to the issue of deposit outflows from mid-sized regional lenders to too-big-to-fail banks that everyone is concerned about, because it is that deposit flight and the liquidity challenges that have led to the collapse of two banks already. We are still waiting to see if a deal can happen for Silicon Valley Bank and Signature Bank. We understand New York Community Bank Corp is looking potentially at pursuing Signature, though no guarantee that deal is done. And we remain on watch for these liquidity challenges at banks here in the U.S. It is so interesting, though, that in light of the deal between Credit Suisse and UBS, we heard from the Treasury and Fed in a joint statement from Treasury Secretary Janet Yellen and Chairman Powell saying that they basically welcome what Switzerland did today, but they still are saying that the U.S. financial system is resilient. Capital and liquidity positions of the U.S. banking system are strong. We're probably going to see how strong over the coming days.
Mike McKee, a key point of our coverage throughout the last week or so. What does all this mean for Chairman Powell on Wednesday?
Well, it really makes his job more difficult in a way, because we're getting to that point where we have to have these Sunday night rescues. And so people don't know what is going to happen when the markets open on Monday. And in the past, we go back to 2008, 2009, Monday mornings were not always the best. We did get the statement, as Kayleigh pointed out, from the Fed and Treasury saying they were in close contact with their European counterparts. And they did increase the frequency of swap lines around the world, which are probably going to be valuable to the Swiss and Europeans as they try to do some cross-border payments over the next few days. But the only thing they said was about the U.S., the capital and liquidity positions of the U.S. banking system are strong and the U.S. financial system is resilient, which raises questions about when the futures start trading, what we're going to see happen with the smaller U.S. banks that we went into Friday worried about and are still worried about as we come out of this weekend, because Credit Suisse and UBS didn't have anything to do with those banks, although the Europeans blamed their troubles on why Credit Suisse went bad. So it's going to be a very interesting morning tomorrow morning, and it will have a lot of influence on what happens with Jay Powell and the Fed on Wednesday.
Everyone's looking at someone else to blame, Lisa. You notice that?
Okay, this is ludicrous. Let's just call it what it is.
Absolutely.
It's insane to call the demise of Credit Suisse as a standalone entity the fault of Silicon Valley Bank. I mean, that's nuts.
They were in the news conference a couple of hours ago, and they also took shots at Twitter And what happened at the end of last year? Make sense of that.
So people are saying sentiment accelerated the demise, but we also heard that they were talking about how to deal with some of the outflows from Credit Suisse as recently as a week ago or 2 weeks ago. So this has clearly been in the discussions for quite a while. That said, this sort of sudden turn in sentiment around the banking industry has caused a lot of concern among regulators. And clearly that is what they're responding to try to prevent some sort of run on the bank.
What was this bank worth in the crisis? 100 billion before the financial crisis. At the close on Friday, 7.4. And this weekend, 3 billion. That's the deal. That's a massive change. Shanali, Kaylee, Michael McKee, to the three of you, thank you. If you are just tuning in, we do have a deal. UBS agreeing to buy Credit Suisse for 3 billion Swiss francs. A lot to work through. The SNB offering a 100 billion franc liquidity assistance to UBS. The controversial part of this, what happens with some of the riskier debt. The government is granting a 9 billion franc guarantee for potential losses from assets UBS has taken over, and we'll talk about that through the whole of the week ahead of us. I'm pleased to say that joining us now is Greg Peters, co-CIO of PGIM Fixed Income. So, Greg, Lisa and I have touched on this over the last few hours, and thanks for being with us this afternoon, this evening. We said this. Last week, SVB, people just turned around and said, it's just a bank for startups and venture capital. It's idiosyncratic. Signature Bank, crypto, idiosyncratic. Credit Suisse, idiosyncratic. It's been a story for the last decade. Is all of this idiosyncratic, or do we have a bigger problem?
Well, not anymore. I mean, contagion is the spread of irrational fear, right? That hunts out the weakest links in the system. And right now, the markets are hunting, right? And so it's looking for any weakness across financials. And so whether it's rational or not doesn't really matter. This has a tendency of taking a life on its own, and that is where we're at right now. And it's also important to remember that ultimately financials are a confidence game. And so there is a call to question around confidence, and that's the state of play, unfortunately.
How has your view then changed? I mean, has your investment thesis changed, given what's happened over the past couple of weeks, the fact that this does tend to take on a life of its own?
Yeah, so it definitely makes us more cautious on the economic outlook. We thought there was a higher probability of a soft landing. Just the inherent underlying growth is really quite robust. That is definitely not the case today. I think the regional bank pullback matters and matters a lot. And then we've had a clear preference around the money center banks, and they're getting kind of thrown in as well. So we still very much like that part of the market, but it's really hard to kind of step into the breach. I think the big thing that happened today, though, was the AT1 market. So I know you talked about it, but it's a 200 billion euro market. And the fact that that entire part of the capital stack was wiped out, and there was a small portion left over for equity players, goes against how it's supposed to work. So that is a part of the market that has to really work itself out here over the next weeks or years even.
Can you build on work itself out and what that means? In other words, is everyone just going to go through their AT1 portfolios and press sell?
Well, they definitely have to be repriced, right? The issue that we've always had with that market is that it's really hard to value. So we thought it was mispriced, too much equity risk relative to what you're actually getting paid in terms of coupon and yield. So I think first order is that those yields have to go higher, those prices have to go lower as that equity option totally gets restruck, and I think that changes the whole dynamics of the market. And then I think there has to be some regulatory explaining as to why the waterfall wasn't a waterfall to assure that 200 billion size market.
Greg, can I just come back to something you said? Equity risk. I often heard them described that way, that they carry this equity-like risk, but haven't we just figured out that they're riskier than equities?
Yeah, which is why I have the problem with it, Jonathan. So, I mean, it's actually okay for those securities to be wiped out. That was kind of part of the documentation, and that's what we thought all along. What's less okay is that the stub equity is treated higher. And so that just doesn't make a lot of sense to me. And I think there has to be some explanation as to why that occurred.
Greg, if you stay there, we'll continue this conversation. I'm going to open up a political question, which I don't think you're going to want part of. Greg Peters of PGIM Fixed Income. Greg, thank you.
And then you're going to turn to me.
I'm going to turn to you and ask you about it. Okay.
Fantastic.
Look, a lot of people are logged on to the Bloomberg terminal this evening for good reason. There's a lot to discuss. And as soon as that headline dropped, ping, 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 messages straight away about all of this. There are questions being asked about whether this was a political decision. So this is what we know so far. On the call, on the analyst call, they were asked about why this happened. We've been told by the UBS leadership that this was a decision taken by the Swiss regulator. They cleared this up. The question that's being asked, and I'm not implying that this is my judgment on the situation, this is just the question that's being asked and it's out there at the moment, so we should address it. Was this a political decision because of the nature of the shareholders in this name and the assistance this name received only a few months ago in a capital raise from the Saudis?
Right.
And is that why the equity portion of this has been protected to some extent? Now, I'm sure they're not happy with where this is. Think about where this priced today in this deal and where it was when they offered that assistance. But that's a question people have asked today.
It's a relevant question, especially given how vocal some of the assistance has been as people stepped up from the Middle East, different big funds to support Credit Suisse in its time of need. All of these questions will be hashed out. I think what Greg Peters is talking about right now is, regardless, people are now understanding that perhaps in practice that has been established by the Swiss regulator that these particular instruments are riskier than equity. And as a result, as he just said, the entire market will need to be repriced. Who holds those? What kind of losses will it look like on Monday morning when it starts really coming to fore as people reassess the valuations
We'll continue this conversation. Greg Peters is going to join us on the other side of a commercial break. After that, Stephen Bigger, 6:30 Eastern Time, about 17 minutes from now, we'll catch up with the research director over at Argus. Equity futures open up positive by about 1/3%. From New York City this evening, good evening.
I'm expecting the Fed to cut rates in September to stave off recession. And there are so many things. You can look at the inversion of the yield curve. You can go back and look at one of the things that Jay Powell told us was their favorite indicator, the 3-month versus 3 months, 18 months forward. That inverted at the end of last year. And generally, once that inverts, you have recession about a year later.
Bob Michele at JPMorgan Asset Management on this programme in the last hour. Just absolutely fantastic. Off the back of this banking turmoil over the last couple of weekends, he now believes, Lisa, that we get a cut from the Federal Reserve in September. What's interesting about this call is because we started the year talking about cuts in September, wiped them out, priced in more hikes, took the hikes back and priced in cuts again. We haven't even got through Q1.
So let's just see where we are in 3 weeks, and then perhaps we can reprice them in or talk about potential ongoing inflation that he counted out. Look, it all is moving so quickly. And when things move quickly in a vacuum, things break. And this really is one of the key questions and the reason why we're watching how the trading evolves heading into the opening tomorrow. How do things kind of shake out among a lot of investors who've gotten rather spooked by some of the emergency measures taken by a lot of regulators?
Got another message across the Bloomberg terminal. As a former Credit Suisse employee, can't help but feel emotional. I think a lot of people feel that way about this institution.
This is a 166-year-old institution that was one of the major banking institutions of the world, had a massive implication in the U.S. as well. And that's really one of the big questions, how that's going to evolve. It is an emotional moment for the thousands of employees also who work there, who now have a great uncertainty around their future employment.
And some might argue have been let down repeatedly by leadership after leadership after leadership after leadership for the best part of 10 years.
The legal questions, the oversight in issues like Archegos, the questions of the businesses that they've gotten into and gotten out of, and the people who they've lost along the way. There have been so many missed opportunities that have been highlighted with this rather dramatic denouement today.
Joining us now, Greg Peters, back with us, co-CIO of PGIM Fixed Income. Greg, let's start here. What's changed for you in the last couple of weeks after, let's call it, the chaos that we've witnessed?
Yeah, so I think what changed is the economic outlook. So I do think that all the financial news that we're dealing with over the past week, and it's just been a week, has changed the outlook. I think the possibility of a soft landing is much less today. I think probability of a recession much higher. I do think that changes the Fed trajectory. But the one thing that we haven't talked about is inflation. So these Fed cuts have to occur only and if only inflation comes down to a level that makes them comfortable. And we're not there yet. So everyone's expecting that this shakeup will bring the economy down and inflation with it. But if that doesn't occur, then that is a whole different outlook, and that changes the entire trajectory of the Fed curve.
Dalip Singh, the chief global economist over at PGIM Fixed Income, came out and said the balance of risks have shifted. Your colleague, also the former markets chief at the New York Federal Reserve. I'm curious from your vantage point whether you see that reflected in your inflation expectations as well, to join with Bob Michael in saying that you could see the whole curve under 3% over the next year.
Yeah, I'm not convinced of that, actually. I still think there's a inflation in the system is much more embedded. I don't see us cutting rates in the same degree that we've witnessed before. I mean, I could be wrong around that, of course, but this all presupposes that inflation gets to 2% or below. But I think we're operating above that line, not below that line. And I think the ability for central bankers to actually make that aggressive move, cutting rates, we don't have that capacity today. And let's not forget, I thought at least we got the playbook from the ECB last week, where financial stability was a concern, but they put that on the side and they said monetary policy on the other side. I'm not convinced the Fed is going to have that quote unquote luxury that the ECB had, but still, there's two tracks that they have to take, and they're battling each other. Would you
be more confident in risk or less confident if the Fed raised rates by 25 basis points on Wednesday?
I don't know. I think the pause is probably the best outcome for that. But I'm not in the camp where, what do they know that we don't know? So why did they cut? I'm not convinced that makes sense. So I think a pause is probably the appropriate response. I think raising rates acts tone deaf, and I think cutting rates acts too suspicious that there is something going on. So I'm hoping for a pause.
Greg, I'm with you when it comes to the economy. This idea that the Fed knows something we don't know, it's ridiculous, and they've proven that themselves. But when it comes to the financial system, to some extent, don't they know things right now that we don't?
Well, if they knew so much, maybe we wouldn't have the SVB problem and some other things, right? So let's not give them too much credit as far as that's concerned. But I do think that central bankers globally are really focused on contagion risk and making the system function. So you saw that with the swap lines. So I really believe that this is a very different response function out of the global central banking community than what we've seen in the past. So I think that matters a lot. So there's a clear, decisive view to make sure that we function globally from a financial stability standpoint. So that gives me a lot of comfort. Whether that translates into a different rate policy, that's the question on the table.
Hey, Greg, I think we're both on the same page here. We don't want to make a habit of this on a Sunday evening, do we? But thank you.
No, we don't.
Greg Peters of PGIM Fixed Income. Thank you, sir. Thank you, buddy, as always. The psychological question here. Jana Randau here at Bloomberg with the team over in Frankfurt after that ECB decision came out with a report. According to people familiar with the matter, those around the table making the decision, etc., they were worried about the signal it would send if they didn't hike. Now, whether you think that should be a thing or not, it's pretty clear that inside the ECB and the Governing Council it was. Will the same be true for the FOMC this Wednesday?
People have tried to draw a distinction between the Fed situation and the ECB situation by saying the Fed is dealing with a much later stage of the rate hiking cycle than the ECB. They are further along in their process of raising rates, the Federal Reserve, rather than the ECB. So they could potentially pause. That said, other people, including the former vice chair, Rich Clarida, Florida of the Federal Reserve said that the Fed was going to take a signal from the ECB. They're
True.
going to raise rates to sort of send the same signal. Do these events really change the scenario that much? We shall see.
Should we do this all night?
No.
Okay.
Do you want to do this all
That
night?
was blunt.
Well, I mean, do you want to do this all
I'd
night?
love to do this all night. Of
Really?
course. No. Coming up, Stephen Bigger,
What did you
Financial
say?
Institutions Research Director at Argus. That conversation is coming up shortly.
I'm expecting the Fed to cut rates in September to stave off recession. And there are so many things. You can look at the inversion of the yield curve. You can go back and look at one of the things that Jay Powell told us was their favorite indicator, the 3-month versus 3 months, 18 months forward. That inverted at the end of last year. And generally, once that inverts, you have recession about a year later.
Bob Michele at JPMorgan Asset Management weighing in on the situation for the Fed, weighing in on what he thinks is going to happen ultimately with monetary policy off the back of the banking failures we've seen over the last couple of weekends. Lisa, where from here? Where from here for these central bankers now?
This is the question. Over to you, Jay Powell. What do you have for us? And people are saying if he raises rates by 25 basis points, he'll be tone deaf to the natural tightening in smaller and regional banks that now are going to have a harder time lending to commercial real estate advisors as well as individuals. And then you say other people say, hold, even cut rates, because right now we're dealing with a very different scenario.
Lucky for us that this economy, relatively speaking, is in a position of strength. 3.5%, in and around 3.5% unemployment, 3.4% only a couple of months ago. Nominal GDP, pretty high. That's going to be the bullish argument still tomorrow morning against all of this. That'll be the pushback.
And then if that's the case, if the Fed doesn't raise by 25 basis points, what's the risk of inflation becoming more unmoored in a way that perhaps is exactly antithetical to what the Fed would like?
That's the dilemma right now that they face. If you are just tuning in, welcome to the programme. Equity futures opened up by about 0.4% on the S&P 500. UBS is closing a deal for Credit Suisse for 3 billion Swiss francs. Coming up, 6:40, about 10 minutes from now. Steve Pagliuca of Bain. We have a deal in Switzerland. The coverage continues. UBS agreeing to buy Credit Suisse for 3 billion Swiss francs. Equity futures trading underway about 30 minutes ago. Equity futures right now positive 0.5% on the S&P 500. At this time of the day, Sunday evening stateside, I know not too much attention is paid to this. Nasdaq futures up 0.5%. But Lisa, wow, what a week the Nasdaq had over the last week.
Meanwhile, we are seeing some move in First Republic. Shares down now 19% in pre-market trading. So you are getting a sense that there is some response in banks as people take a look at what the read-through will be in the United States. Obviously, we're looking at pretty thin trading at this point, but especially the second downgrade by S&P doesn't exactly revive confidence in some of these medium-sized banks.
We'll come back to that story in just a moment. I want to talk about the downgrade that we had on First Republic. This is what Standard & Poor's had to say following Thursday's uninsured deposit of 30 billion by the 11 largest banks in the country, together with cash on hand. First Republic is well positioned to manage short-term deposit activity. This support reflects confidence in First Republic and its ability to continue to provide unwavering exceptional service to its clients and communities. Katie Lyons joins us now from DC. Katie, tell us the latest.
Well, this is, as you say, the second downgrade further into junk territory that First Republic has gotten from S&P Global Ratings. That statement coming from First Republic, the company, the ratings agency, the analysts sounding much more vicious about the long-term outlook for this bank. They said that those deposit inflows, the $30 billion, which you just mentioned, are not a longer-term solution to the bank's funding stress. And those analysts went on to say attracting meaningful deposits will be difficult, constraining the bank's business position. This really comes down to the issue of the deposit outflows from these mid-sized regional banks into larger banks deemed too big to fail. And this really speaks to what we were hearing from over the weekend from mid-sized banks asking the FDIC to ensure all deposits for the next 2 years to prevent any kind of massive bank runs coming for those banks. To quote that statement that they sent to the FDC, they said, notwithstanding the overall health and safety of the banking industry, confidence has been eroded in all but the largest banks. Confidence in our banking system as a whole must be immediately restored. And of course, talking about that lack of confidence, First Republic is just one primary example of that, John. And that is going to be the stock we are watching when the opening bell rings tomorrow morning.
Looking forward to that open. Let's hope that we get the result that some of these lawmakers want to see, because right now we don't want things to get any worse, and arguably things are getting worse at the moment. Equity futures are getting better. They're positive on the S&P 500 by 0.75%. On this idea that we have a two-tier banking system, there was this fascinating exchange last week when Secretary Yellen went to Capitol Hill to testify in front of the Senate Finance Committee. Take a listen to what she had to say.
Every community bank, regardless of the size of the deposit, will they get the same treatment that SVB just got?
A bank only gets that treatment if the failure to protect uninsured depositors would create systemic risk.
And that right there is the problem. Stephen Bigger, Financial Institutions Research Director at Argus, joins us right now. Stephen, thanks for being with us late into the evening. I say late, 6:30. It's late for me because usually I have to get up on a Monday morning very early.
It's absolutely late. No, it is.
Let's move past that. Stephen, thank you for being with us. Stephen, what do you make of what Secretary Yellen just had to say there on the Capitol Hill just earlier this week to Senate lawmakers? This idea that we have this two-tier banking system, how do we address that this week?
Well, I think that's actually been the case, right, with the systemically important financial institutions, these SIFI banks that have operate by a different set of standards and have greater backstops and so forth, because they're deemed to be systemically important by virtue of the name. So it just means that banks a little farther down the asset curve may not have the same type of protections. They aren't regulated in quite the same way, and they're not viewed as having the chance to disrupt in a huge way the American economy. And so it's interesting. I think that at the same time they're talking about raising deposit insurance and so forth to get a little bit more confidence restored in the deposit. I think we have a kind of a deposit catharsis going on today, and just more money is going to continue to leak out of smaller banks and into large institutions that are deemed systemically important. So it's an interesting concept.
This phrase systemically important is becoming somewhat confusing right now, especially since some of the measures taken for U.S. banks were under a systemically important provision. How can we determine when a bank is systemically important or not only for the whole financial system, but for particular sectors that are very exposed to that particular bank?
Well, today it's just asset size, right? And I think that probably does get extended out. I think, we're bound to get some greater rules and regulations here, and most easily of which is that you go back down to a lower asset size that would constitute systemically important. So I think that's one thing that is likely to come out of this. And of course, the rules were relaxed, and we can debate that even if Silicon Valley Bank was in the systemically important category, this still would have been missed because the interest rate duration risk was not factored into the stress test equation. So I think, the regulators have to do a lot more in terms of looking at a bank's underlying structure, looking at the deposit structure in particular, seeing where they have where their tentacles are in the economy, and creating regulations around that to try to prevent this in the future.
In the meantime, you talked about a deposit catharsis that we're seeing take hold in a lot of smaller and medium-sized banks. What is this region going to look like, this particular asset class going to look like in a year, 2 years' time? Is it going to be highly consolidated? Is it going to be highly regulated? How is it going to change in the face of this catharsis?
So I think, this is just a long-running type of consolidation in the banking industry. What we don't hear often enough is that there were actually 10,000 FDIC-insured banks going back to 1994. 95, we dropped below 10,000. Today we have 4,700, having dropped below 5,000 in 2021. So that's a halving of the number of banks in the U.S. So that just gives depositors fewer and fewer places to put their money. So the large get larger and the small get smaller here. And I think we continue out this trend. And as far as regulations go, I think you'll probably see higher deposit insurance costs. I think that's a given, particularly if they do plan to raise it to 500 or $1 million in terms of individual depositors. The last time we got an increase was after the financial crisis of 2008. It went from 100,000 to 250. So I think we're bound to see that. New stress testing regarding the interest rate risk, particularly now. The stress test is all about what happens when interest rates bottom out, when they drop to below 1%, 0.75 in the case of the last year's stress test. So I think we'll have the reverse of that testing. Higher capital cushions, and the thing I worry about is not for the large banks because they can handle this, but what happens to the profitability of banks as it continue to be eroded from just additional regulation and the need to maintain much higher capital levels.
Stephen, after this UBS-Credit Suisse take out, take under, call it whatever you want, there was this news conference. I'm sure you watched it. And in the news conference, they were keen to point out this is not a bailout. We heard that from the president too. Now, if the insurance premiums go up to cover basically unlimited deposit insurance, who ultimately bears that cost?
Depositors will. Obviously, the banks will try to squeeze what they can. It just means lower interest rates for them if they have to, if banks have to kick in more deposit insurance fees for them. So yeah, and as far as the bailout goes, it's hard to see how it is not a bailout. I mean, you can call it something different, or recapitalization, or something. But these are mergers that are happening in the case of Credit Suisse at lightning speed and over a weekend kind of thing. And certainly the Credit Suisse stories, I don't cover it personally, but it has been unwinding, we know, for some time. And this was maybe just the final nail in the coffin to do a deal like this over a weekend and after the troubles they had last week. So a bailout, yeah, I would use that.
Stephen, there are some general assumptions being made now. One is that we're going to see tighter lending standards, tighter financial conditions off the back of that. And the second is that profits are going to be challenged at the banks going forward. Would you agree with both those assumptions at the moment?
Definitely. I think the removal of liquidity, what the Fed is doing, I mean, just by raising rates, and they seem to be headstrong, and our house view is that they'll continue to do it again this week. And that's removing demand from loans and is slowing things down. So banks add to that. The banks will be a little bit more cautious with their capital now and not, lower their lending standards at all. In fact, probably increase them. And then in terms of bank profitability, I mean, that's one way. That'll mean lesser loan growth and probably less margin expansion, higher costs related to regulation. So, yeah, the picture is not particularly good for bank profitability. I don't think it's a big step down. But at the margin, yeah, you'll have higher costs here and lesser demand.
Hey, Stephen, thanks for being with us on a Sunday evening. Stephen Bigger there of Argus on the situation with the financials. Those two assumptions. One, you're going to see tighter lending standards and ultimately tighter financial conditions. And then two, what's going to happen? Profits get hit and growth's going to hurt. We've seen that from Wells Fargo, from JPMorgan, from Goldman, Morgan Stanley, all talking about the same thing. This was Wells on Friday. If you missed the program on Friday, we were talking about this. Wells Fargo essentially saying the following. I'll read the quote with you. Recent developments in financial markets are compounding the Fed's efforts to slow the pace of economic activity, which raises the probability of recession. Bob Michele at JPMorgan just an hour or so ago saying that's it, one-way trip to that destination. Wells Fargo went on to say, we look for real GDP in the US to contract 1.2%, Lisa, later this year and into early 2024.
And this is a reason why people are reassessing their view on risk assets, as well as the interest rate path. I mean, Bob Michele saying that he could see as soon as September rate cuts. I mean, that sort of specter raises a question. OK, what about inflation, as we heard from Greg Peters? These are some of the ways that the landscape has dramatically changed for a lot of people waking up.
Just what a massive change. Yeah. Torsten Slok Apollo, good friend of this program. No landing, hard landing, just like that.
And how about the big banks getting bigger? We haven't even talked about that. That was something that I keep thinking about as Stephen Bigger was talking. Honestly, the consolidation that everyone was hoping to avoid is only accelerating at this point.
And parts of the market that regional and small banks, medium-sized banks dominate, if they pull back, who steps in?
Correct. That is one of the key questions. And perhaps the next guest that we have coming up can answer that question.
I was trying my best to tee up
that was good. That was exactly where I was going.
Senior advisor at Bain Capital is going to join us very shortly. If you are just tuning in, welcome to the program. UBS agreeing to buy Credit Suisse for 3 billion Swiss francs.
Yeah, it is a bailout, and it's a bailout, and you heard the minister say it's a bailout because they're dealing with a systemically important bank at a time of market turmoil. Now, of course, you're going to always be dealing with a systemically important bank at a time of market turmoil. That's by definition what happens when you have a systemically important bank in trouble, but they just don't want to use that phrase.
That was Mohamed El-Erian there, weighing in on the latest situation with Credit Suisse being taken out. Taken under's a phrase I keep hearing this evening by
what are
UBS
these
for
things
3
mean?
billion Swiss. I
Taken
don't
under
know anymore.
wing,
I'm losing track.
Yeah.
But it's a messy one. 100 billion Swiss franc liquidity assistance from the S&B, a government grant of 9 billion, and then the other story, and we've talked about it all day, $17 billion worth of risky bonds wiped out and taken down to zero.
What I find really controversial, and it will be a point of discussion, is how the Swiss regulator single-handedly wiped out a more than $250 billion market out there of these particular bonds, because essentially everything has to be re-rated on these new assumptions that were decided in the first example by Swiss regulators, evidently.
We need to talk about US banks too.
Yes.
Pulling back. Mid-sized banks over the weekend pleading with officials to insure all deposits. What was it, for 2 years?
For 2 years, for the FDIC. There's a larger question, which is how do they fill the role of the credit impulse that they've provided? They accounted for 67% of commercial real estate loans. They
67?
Yes, they accounted this according. I'll get the exact data source coming up, but this is exactly why people are concerned. They accounted for almost 40% of loans to smaller businesses. This is one of the big mainstays of credit impulse in the U.S. What happens when they go away?
Joining us now, and Manus should be watching the basketball, as Lisa mentioned in the commercial break, but he's not. He's joining us, and we're grateful for it. Steve Pagliuca, Senior Advisor at Bain Capital. Steve, wonderful to catch up with you, sir. I asked this question earlier. I really want you to respond to it as well. What's changed in our financial system in the last couple of weeks?
Well, we've had a recognition that the inverted yield curve has, hampered the balance sheet on a paper basis of some niche banks. And when the first crisis happened in 2008, the whole issue was systemic collapse. We don't have a systemic collapse now. We have a crisis of confidence, and that crisis of confidence can ratchet into a bad economy. And I think the regulators and the FDIC are trying to stop that. When you step back, all the focus was, oddly enough, and appropriately, on systemic risk. This is not a situation. CSFB is a large bank, but it's controllable. First Republic and Silicon Valley Bank were banks focused on a certain area. And when those customers lost confidence, they started pulling capital out, which brought those banks down. I think people are doing the right thing and leaking in. I wouldn't call it a bailout. They're using insurance right now, and it's the right thing to do for the economy because, as Lisa said, something like 45% of consumer loans are from these small banks less than $250 billion in assets, 60% of residential real estate, 80% of commercial real estate. So if those banks are having issues because of crisis of confidence, not because they have bad loans, not because they bought derivatives that are worthless, just because there is a crisis of confidence and a flight, oddly enough, to the larger systemic banks because people perceive those as money good, that'll cause ratchet into a problem for small business, for the economy. So that's what we're trying to prevent here. We want to get out of what I'll call a vicious cycle into a virtuous cycle.
So people are looking to you, Steve, as perhaps the voice of private equity and private debt. Are you the ones to step in when some of these regional banks pull back?
Well, private debt, private equity debt has been growing dramatically in the last 20 years. When I started in private equity, there was virtually none of it. It's a really good model. They use private equity concepts to evaluate the strength of a company and loan directly privately. And you don't have the issue of losing depositors' monies. You have investors, and you're responsible for those investors, but you don't have the risk of bringing depositors down and wreaking economic havoc. So private capital has taken a large share, will continue to take a share from the banks. I think the banks will still play an important role. I think it's a very fixable problem, and they're doing the right things. And hopefully these guarantees of deposits will make people comfortable that they can leave money in those banks that play a vital role in each community.
But you said something, Steve, that I want to pick up on about this mismatch in liability timeframes that gets solved in the private equity, private debt model. Do you think that it's inappropriate to make some of these longer term loans with deposits as these regional banks do? I mean, yes, they fill a void, but do you think that there is an inherent risk that can get band-aided over but is not solved by some of the measures we've seen?
Well, it's interesting. Ironically, diversification is your friend. And if you're a local bank, or if you're a specific vertical industry bank, or you're a bank that has the same kind of customer, you don't have diversification. So diversification, large banks create systemic risk, but they're actually more diversified and less likely to have issues because they can invest in a broader swath. I do think there are models that will work with regulation where you pay attention to making sure you're matching liabilities and with changing the guaranteed deposit rules. I think there'll be a viable role for local banks.
How concerned are you about a more market deterioration in the creditworthiness of companies? And I say this as we hear a host of people, whether it's Bob Michael or Greg Peters, saying that suddenly their view of recession was brought forward, that they see that suddenly the lack of loans from some of these institutions will accelerate a downturn that a lot of people have been expecting. Are you seeing that on the ground with deal making with your portfolio companies?
Well, we've been fortunate at Bain Capital. We hedged a lot of the debt, and I think 95% of our companies are hedged. So we're not experiencing issues at the point. The economy has still been strong. If you have flown a flight, I've flown many flights, probably 20 flights in the last month. They've all been full. Restaurants are full. So the real economy has an inflation problem, but it's still very active. So I think that there was a recession coming one way or another. There's always a catalytic event, and it's always something you don't expect. So Silicon Valley Bank may be the harbinger to kind of crystallize this recession, and hopefully we'll get through it. It'll get stabilized, and then we can move back forward.
Steve, forgive me for asking a personal question, and by all means, you don't have to answer it. But you're a successful individual. I imagine there are some holdings above the FDIC limit that you have, just I imagine. Have you changed how you bank personally over the last few weeks?
I have not, but probably by pure luck, I had no banking relationships with any of these banks that are in trouble. And again, the U.S. banking system, the large banks are strong. Bank of America is very well run. JPMorgan is very well run. We do business with them all the time, and they're very well run banks. And the regulators have been on top of them ad infinitum. So again, this right now is a crisis in confidence. It's a containable problem in my view. It could still go awry if we don't do the right things, but there is not a fundamental issue with these banks, which there was in 2008. Banks had fundamental issues. They had bought tranches of mortgage-backed security tranches that were not in the money, and they lost billions of dollars, and that put them in jeopardy. That is not what happening right now. CSFB is more of that model, but they're fixing that. These are more specialist banks that had a liquidity problem. They have not lost hundreds of billions of dollars, and they have not made, as far as I know, they have not made really imprudent and risky loans that put depositors at risk. So we've got to stop this. We've got to put confidence back in the system, and that's what the Fed is working and Powell's working on doing. And once we do that, we can get the economy going back again. And there's billions of dollars of private capital, private credit capital out there that I think will fill this void.
I imagine, and that's what Lisa and I talked about, the idea that the Bains of this world maybe step in, Bramo, and take on some of this.
They have the cash, evidently, right? They've had the dry powder. And suddenly, if you have a lot of companies and individuals and commercial real estate developers that need cash, well, where does it go?
Hey, Steve, thanks for answering that question in the spirit in which it was intended. Thank you, sir. Steve Pagliuca there of Bain Capital. Bramo, these are questions we're all confronting as individuals as well over the last couple of weeks, and some people will come out on those questions differently.
Banking is a game of confidence, and the confidence has been breached at a lot of the smaller and medium-sized businesses. People talk about the open window, the discount window at the Federal Reserve, and how much was used of it, a record amount of borrowing. The question now is, how do you revive it? As you asked earlier this evening, how do we look at a situation where potentially this doesn't end in the way that we need it to end?
Coming up, we'll catch up with Bloomberg's David Inglis and guide you towards the Asian session. Equity futures right now, positive, 0.5%. Live from New York, equity futures positive, 0.5%. David Inglis, what's coming up?
Yeah, John, I mean, we could have been in a much worse situation right now going into this Monday. It's not a normal day, certainly. A very dependable gauge of risk appetite, pointing higher in Aussie yen. But that being said, I'll leave you with this. S&P future weakness right now coming through. Australia opens up top of the next hour. Back to you guys.
Looking forward to your coverage, sir. Thank you. Bramo, thank you.
Thank you.
We're doing this tomorrow morning?
We are. I'll see you in a couple hours.
If you say so. From New York City this evening, good evening.